Okay, so good morning, my dear future chat accountants. I think many of people are joining online, so not a problem. We'll continue. One good news, I don't know whether it may be bad news, good news that you have to take a call. We initially thought of 3 days, but I have something which came up, so I'll be doing it today itself, the completion. So it will be a 2 days session. Maybe you get one more day for you to read for yourself. So we are doing foreign exchange. Let us move on with respect to the next topic on which is forward contract cancellation or forward contract execution. Let's just understand the main terminologies, then I will go further. There are basically three terms for you to understand. One is called as the exchange difference. And then we have interest on outlay, and then we will have the swap difference, swap difference. Exchange difference is between always bank and customer, whereas interest on outlay is for transaction made by bank with interbank. Swap difference also is an exchange difference, is the transaction between bank and interbank. Why this understanding is important, I'll tell you in a while. Mainly we have the type of transactions which are these things, that is, we will either have cancellation either before due date, after due date, that does not matter. Cancellation, we take it as cancellation. Then we have early delivery transactions, and then we have overdue contracts. So cancellation may be before due date, after due date. If the cancellation is before due date, we take the forward rate to cancel. If the cancellation takes place on due date, we take the spot rate to cancel. Early delivery means the due date, before that only you go and execute and the bank is obliged to do it. Overdue means due date is over and still it is not executed, means compulsory cancellation. Extension, an extension will be treated separately, therefore extension will be a fresh contract always. I'm not discussing it separately here. What is important is this: exchange difference will come in cancellation because you are transacting with customer. Cancellation will not happen in early delivery. It is execution early, but it is not cancelled, so it will not come in early delivery. Overdue contract also, exchange difference will come because you are of course cancelling the contract. Interest and outlay on cancellation will not come. It will come on early delivery because there is a transaction before due date and there is a transaction after due date, so interest and outlay will come in overdue contracts. Swap difference will not come in exchange difference, cancellation. Swap difference will come in early delivery. Swap difference will come in overdue contract. Just know this basic table. This will help us a lot when we do the transactions, because there will be quite a few calculation to be made, can be confusing. And because the exchange difference happens between bank and customer, when you calculate this, margin will apply. You should take margin into consideration. But when it happens on interest and outlay, margin don't apply because it happens with interbank. Interbank means no margin. And bank and interbank also, then there is no margin. And one more important thing is, when a profit comes for a bank and when a loss comes for a bank, whether they will receive something or they will pay something, That depends on whether bank is transacting with the customer or bank is transacting with the interbank. Just to give an idea once more, so when bank is transacting with the customer and if bank makes a profit, which means the profit need to be collected from customer when the bank is transacting with the customer, and if bank makes a loss and that loss is payable to customers. Whereas when the bank is transacting with interbank, it is a different matter. When the bank is transacting with the interbank, if bank incur loss, that loss is recoverable from the customer. Whereas if bank makes profits with the interbank, and that profit will be payable to customer. So understand this basic concept very clearly. When a bank is transacting with the customer, bank's profit is receivable for the bank. Where the bank is transacting with the interbank, the same profit they have to pass it on to the customer. So it is important with whom they are doing the transaction. So these three are the transaction which will come, and you will be able to understand to whom they have to pay it. Let's go to the problem. Early delivery. This is the problem. Again, I will not explain the logic behind this, actual transaction behind this. I'll straight away only go for the shortcut method. What is required for exam, I will stick to that. On October 15, Mr. X, an exporter, enters into forward contract with PNB Bank to sell US dollar 1 lakh. So if you think early delivery transaction, you have to think from bank point of view. You don't have any choice because bank is doing many transactions. X exporters into forward contract, therefore the exporter or the customer is going to give the dollars. So from bank point of view, it is going to be a purchase transaction, and of course with the bank to sell US dollar 31st December. However, due to request of importer, Mr. X received an amount on 20th November. Mr. X requested the bank to take the delivery on 30th of November. So this was supposed to happen on 31st of December, but customer is requesting on 30th of November itself early delivery. Interbank rates are as follows. 1 month premium spot. If bank agrees to pay early delivery, then what will be the net inflow to Mr. X, assuming that the prevailing lending rate is 18%. So when you think from bank, bank also has to transact with interbank. So with the interbank, bank would have entered into sale transaction. So basically bank will collect from customer and they will pass it on to interbank. So if you write this kind of a table, it will be faster. So let's stick to this table. You get the answer very fast. What bank does with customer, what bank does with interbank. Think from bank point of view. That is the key. Original contract, as I just explained, with the customer it is forward buy, and therefore with the interbank it will be forward sell. That is called as the cover transaction. The rates given, forward rate with the customer and with the interbank they have not given, does not matter. Cover rate will come into play only in case of overdue contract. It will not come into play in any other types of problems. I just told X. Due date, that is was supposed to be on 31st December. What you're supposed to do, you are supposed to execute this contract. That means the bank point of view, they will collect the dollar and you're supposed to pay and receive whatever the cover rate, and you give the dollar. That is what is this cover rate was supposed to happen. That rate not given because it does not matter. It does not have any impact. The next thing what you do is, it's a case of early execution, early delivery, that is taking place on 30th November itself, and therefore what was supposed to have taken place on 31st December is taking place on 30th November itself. Okay. So basically whatever forward buy you have entered into, that will be, you can repeat it, forward buy. Okay. This is what you have to remember as a shortcut. Try to understand. This is the original forward buy contract Now what you do is opposite spot sell contracts. So what you have to do while solving problem is this. So that's I've written so much, but what you have to understand is very simple. From bank point of view, what is the original contract? From bank point of view, the original contract is forward buy. This is the original contract, forward buy at the rate of 65.4. It's a case of early delivery. Early delivery means two things will come. One, swap difference will come, other, interest on outlay will come. Now regarding the swap difference, what you do is this: opposite of forward buy. Opposite of forward buy is spot sell. Opposite of forward buy, spot sell. And opposite of spot sell, forward buy. That's all is the difference you have to do for swap difference. As far as interest on outlay is concerned, what you have to do is only this: what is the transaction that you're doing is spot sell, and another transaction what you're doing is this forward buy, no, what was supposed to be executed later, and that you are going to execute now. That is a cash transaction taking place. So I will take that forward buy. On this I'm going to apply the interest on outlay. That is all with respect to early delivery that you have to understand. Simple technique: start with original contract, swap difference is the opposite of that contract, spot sell, and opposite of that opposite, which is forward buy. And interest on outlay, that is spot sell, same as this, and original forward contract, whatever you entered, that will be executed. This much remember, that's all is required for early delivery. Let's fill up the numbers. Spot sell, they will be selling in the interbank at a lower rate. Spot sell, lower rate is 65.22. Minus forward buy, 1 month premium. Premium means I am going to add, and this is called as swap points, and the swap points are the increasing order, ascending order, that will be added. So in this case, forward buy, I need to buy at a higher rate. So it will be 15 plus 65.27. 65.27 plus 15 means 0.15, last two digits. 65.4. Okay. Yeah, that's what I was telling. So original forward contract is with the customer, that is what 65.4. You do opposite of that, that is what I've written, original opposite, and then you will be opposite of that, that will be like original. So 65.22, that is what is the rate which we just opposite spot sell. Spot sell, what I've just mentioned here. Yes, 65.22 is a spot sell, and forward buy will be 65.27 plus 15, 65.42. So spot sell 65.22, forward buy 65.42. The difference between these two, negative number, it's a loss, and loss need to be recovered from customer because it's a transaction the bank is doing with the interbank. The interest on outlay, as I told you, it will be spot sell. That thing will repeat, and then you are going to consider the original rate, that is 65.4. That is, these rate will come. Spot sell 65.22 and forward buy, these two will come because these are the two cash transaction taking place on this date, cash transaction. So 65.22 sell, 65.4 buy. So on this 18% for the period of number of days, date of transaction till the original due date, this also a loss to be recoverable from customer, and original contract will be executed, which is $1 lakh into 65.4. So you get 65,40,000. This is the amount that you need to pay to the customer. You need to recover 275, recover 20,000. Net amount is the amount that bank has to pay to customer. So this format, if you are clear, the early delivery transaction is taken care. I just repeat the process once more. What you should do: you write two things. One is the swap difference, the other is the interest on outlay. The swap difference is opposite of original, and this is opposite of the opposite, so this will be like original. This is swap difference. What will be the interest difference? Whatever you do in the spot market, this is spot, this same thing, this spot market and the original rate. This is the two things that will come in case of early delivery. That's all you have to remember. This is what you should remember. Swap difference, opposite of original minus like original, interest, spot, that whatever we have just taken now, minus original. Okay, so I hope you have got this one. This is regarding early delivery. So see if you have any doubts. If fine, I'll go to the overdue contract. Okay, so I'll go to the next problem. Overdue contract, this concept means the due date is over, but the customer is not come back yet. Let's read the problem. An importer booked a forward contract with his bank on 10th April for $2 lakh due on 10th June. Due date is 10th June. The bank covered its position on market at 64.28, that is the cover rate. Exchange rate for dollar in the interbank market on 10th June and 20th June is given. Why 20th June is important? Let's read. Exchange margin 0.10, interest and outlay 12%. The importer requested on 20th June for extension of contract with the due date on 10th of August. So he came to the banker on 20th of June. That's why they have given information on 20th of June. So these rates will be used for cancellation purpose. The exchange difference, what I was discussing. Rates rounded off to 4 decimals in multiple of 0.0025. Bank swaps by selling spot and buying forward. Calculate the cancellation rate, amount payable, swap loss, interest on funds, new contract rate, total cost. Okay. Again, this is one of the repeated questions asked in examination, so I will try to put across the shortcut. One small point, recently in the RTP or MTP question, they have given the 13th of June data as well, in the sense 3 days after the due date. I'm not sure whether it's an amendment or something, because I searched enough, I could not get it. But if question comes in exam, what you should do? Do not take the date on 20th of June for cancellation. Take the date of 13th June, 3 days. That is after the date of due date, it is assumed to be cancelled. So 3 days later, the rate, use it for cancellation rate. I'll tell you which rate to take it. The shortcut you follow is this. Okay. So what shortcut you can do for overdue contract? This is just 10 seconds shortcut. Try to remember. What bank is transacting with the customer? Original. What bank is transacting with the customer is forward sell, because importer customer needs it. If you done with the starting point, then it's just opposite. With the customer, it is forward sell. With the cover rate, forward buy. On the due date, opposite of this, forward buy, opposite is spot sell. And on the due date, opposite of this, that is forward buy. And on the cancellation date, it's opposite of the original one, which is spot buy. So remember like this: S, B, S, B, B. Sell buy, buy. S, B, S, B, B. That's all you have to remember. With the customer, with the interbank, what is happening on the due, on the original date, On the due date it's opposite, and on cancellation it is going to be opposite of the original one. So this forward sell to spot buy on cancellation, and that is called as the exchange difference. Now if I told you the 3-day amendment, if 3-day amendment applies, you don't do it on 20th of June, you do it on 13th of June for cancellation purpose. Then this forward buy spot sell, what you see here, the difference between those two will be called as the interest and outlay. You are going to calculate interest and outlay, and from spot sell to forward buy, this will be the swap difference. So 3 types of calculation done in this shortcut. Shortcut is SBSBB. So what is the original forward rate? It was 64.4. Just to be in that line. So original rate was 64.4. We can see here, this is the number. Then what will be the rate on forward buy? Forward buy, that is the cover rate. Cover rate is 64.28. So 64.28. This number 64.28 cover rate. Spot sell. Spot sell, look at on 10th of June, spot sell rate will be 63.28. So that is what this number 63.80. 63.80 on 20th of June, that is spot sell. On the same date, forward buy. On the same day, 20th of June, they are going to do forward buy. So don't look at this 20th June column at all. Look at 10th of June column, but June end. June end means this one, either 63.92 or 63.95. It's going to be higher rate. The higher rate is 63.95. Don't apply any margin money. It is a transaction with interbank. This is done. Then spot buy for the purpose of cancellation. Cancellation spot on 20th of June, spot buy, which will be what rate? 63.68 or 63.72. This is the transaction the bank is doing with the customer. Therefore, they are in advantage position. You will do at 63.68. And you're taking a lower rate, and margin money will come because you're transacting with customer, and you extend the position. You're already taking a lower rate, extend the position, so you do minus 0.1%, margin is subtracted. If this was given on 13th of June, only this rate you would not take on 20th of June, the 3 days after due date. If that one more column is required, was given in the problem, make use of this. Then difference between these two, as I told you, this buy to sell is the interest and outlay. Then spot sell forward buy is swap difference beginning to end, and that is the exchange difference. So rate we know, format we know. Now just have to calculate. This is 63.68 minus 0.1% and round it off. So what do you get? $63.68 into 0.01, 0.1%. 0.06368, subtract from 63.68, you get 63.6163. Look at only last 2 digits, 63. The closest number we have is 75. Cancellation rate is that, the last rate, cancellation rate. And if 13th June information was given, you would have taken that. Keep that in mind. Then amount payable basically is the exchange difference, that is 64.4 minus this number what we calculated, 64.4 and 63.15, so 6175. The difference is multiplied by $2 lakh, you get 1,56,500. Remember, this is a profit from the point of your bank view. Transacting with the customer. So for a bank, transacting with the customer means this profit is receivable from the customer. I mean, amount payable by the customer. For the bank, it is receivable because bank is making profits. That is what is exchange difference. Amount payable, exchange difference. Swap loss difference between these two, 63.8 minus 63.15. The difference multiplied by $2 lakh. It's a loss because you see sale rate is less, and it's a loss the bank is doing with interbank. So this loss is to be recovered, again payable by customer. Interest and outlay, the difference between these two, forward buy and spot sell. 64.28 minus 63.8, again a loss. The bank is incurring this loss with the interbank. This loss need to be recovered from customer on 2 lakh at 12% for a period of 10 days. This gap, the date of cancellation and the original due date, that is the gap on which you have to calculate interest. New contract rate, the fresh forward sale contract, fresh rate he requested on to be postponed till 10th of August. He requested on 20th of June to due date on 10th of August. So look at the 10th on 20th of June, look at August month, either 64.18 or 64.25, and you are selling, because you are selling to a customer, you will sell at a higher rate, that is 64.25, and you are selling at a higher rate, so even more higher rate, margin you can add, and you are transacting with customer, therefore it is advantage position for the banker, and margin also apply for transaction with the customer. Total cost, that is the exchange difference, swap loss and interest and outlay, so 234, that is the total cost. So that's all the solution. You need to have the shortcut, you remember clearly, and which rate when to apply, and the margin money when to apply, when it is loss for the bank, when it is profit for the bank, clear with those transactions, this is taken care. So take a look at this calculation and the formats, see if you require any explanation again. Just in because this contract is not cancelled yet, this is still open, it's that month end, that's the reasonable thing. So on 10th of June I'll take the June month end, so that the as long as this contract is alive, we have a corresponding one cover transaction also. So this cover transaction is executed, now this cover transaction is renewed kind of thing. So that is what this forward buy is closed and new forward buy is opened. It's like a renewal contract, you can also understand like that. So this is the shortcut for, again, these kind of shortcuts I can 100% with confidence can tell you it is not there in any textbook, it is not there in any study material, it is not given by any other faculty. This is the format which is evolved in my own classes after so many times of repeatedly doing same problem, because my experience that every time student will understand, but somehow they are not able to repeat it later because of the conceptual understand it, you remember it, but when you look at the problem you don't get the confidence, you need a format. So I came up with this format. So it's not a result of just one or two batches, it's a result of multiple batches took in multiple places, maybe after 2, 3, 4 years, maybe 10, 12 batches, this format is emerged. So make use of these formats because it would not be available elsewhere. Usually these kind of problems people easily give up. If you can encash these things, that is where you will have edge. For export transactions, it would be opposite. Yes, for export transaction, this would be exact opposite. So once you understand import, then examination will be exactly just reverse. But so far as I have seen the exam question on this, they have asked this 5-6 times. Every time they asked only import transaction. Because institute is waiting. Let any student solve import correctly. Then we'll talk about exporter problems. So once it is just a matter of understanding one format clearly, then modifying it to the export, exact opposite transaction. Okay, so focus on the format. Numbers, you can always take it later. This will be available in the YouTube for you to take the numbers. What is important is identifying these transactions. Every transaction is by bank. That's the heading from bank point of view. Only on the spot buy, the bank is on advantage position and they extend their advantage position by applying margin rate. All other transactions are happening with the interbank and no margin. Okay, so this is with respect to cancellation of forward contract. Overdue contract, yes, institute has given so many calculations, so many lines, this much format, at least you are clear, it will be easy for you to follow. Okay, so let's go next. We have hedging techniques. So many hedging techniques are there: forward hedging, money market hedging, option hedging, currency hedging. Let's try to do that in one different problems. So let's come to this. Sky Products Limited of Mumbai, an exporter of seafoods, has submitted 60-day bill for euro 5 lakh under an irrecoverable letter of credit for negotiation. The company has desired to keep 50% of the bill under exchange earners foreign currency account, and the rate for USD for euro in the interbank rates are quoted are as follows. Rupee slash USD, so it is 1 USD equals to, therefore USD slash euro means it should be 1 euro equals corresponding things. Rupee slash USD, so 1 USD equals to, same rule, USD slash euro means 1 euro equals. Spot 1 month, 2 month forward, 3 months. Transit period 20 days. Interest on shipment is 8%. Exchange margin 0.1%. Assume 365 days. You're required to calculate exchange rate quoted to the company, cash inflow to the company, interest amount to be paid to the company, so to be paid to the bank by the company. Just 1 second. Okay, so this problem is from exporter point of view. So this transaction, what we are trying to understand is for exporter. What kind of forward contract an exporter will enter into? He will receive dollar from his client, which he needs to convert into rupees. So the dollar need to be sold. So for exporter, we will always enter into forward sale contract. That is what hedging you are going to do it. So what is that period we are going to apply? Transit period is 20 days, and he has submitted a bill of 60 days. So you will collect the money after 60 days. The transit period is 20 days. So total period after which you need the money would be after 80 days. 60-day bill and then 20 days transit period. So ultimately you will take 80 days to convert your cash flows. You are given spot rates, and spot rate is given. Then after 20 days is transit period. Yes, the total usage period is 80 days. but you need the money. I mean, you will ultimately get the money after 60 days. The transit period, I don't know whether it's applicable for the goods to be received 20 days later, or after 20 days you receive 60 days further. Those things you don't have to worry. Let's stick to our invoice period of 60 days. Let's stick to that information. 60 days means we are going to look for the 2 months information. So 2 months forward contract is what we will take it up. 2 months forward contract. So we have two things. One is rupee slash USD, then USD slash euro. So what they have given is which currency? They have given euro of 5 lakh. So we need conversion from euro ultimately to be converted into rupees. That is the requirement. We have to sell euro, convert into rupees. So how are you going to write? Euro, then from euro you are going to convert it into USD, and from USD you are going to convert it into the rupees. And I told you, if you remember, in the case of cross rates, you have to keep all the transactions in sell or all the transactions in buy. In this case, euro is being sold and into rupees, so euro is what we have given. You have to think from euro point of view. Euro is being sold, and therefore euro we are selling. Okay, selling euro means this USD also now we are converting it to rupees. Therefore, in this transaction, what we are selling is selling USD. Euro will be which side? This is 1 euro equals. So this is euro on left hand side. So I can multiply, and this is oh, this is one more point. No, they are not. Are they converting it to rupees? The company desires to keep 50% of the bill under exchange earners foreign currency accounts. Okay, never matter. Let's just complete this, then whether required or not, let's apply it later. So euro is left hand side, so we'll multiply. What about USD? USD is also 1 USD equal to so much of rupees. Again, left hand side, we will multiply. Now selling euro will be at selling will be at lower rate. So lower rate will be which numbers? Either 1.0775 or 1.8. It's a straightforward thing, so it is going to be 1.0775. 1.0775. And here also lower rate, the lower rate will be 67.80. Selling at a lower rate, 67.80. We have to consider the margin as well. I mean, margin, the swap points after 2 months. So for 67.80, the corresponding thing is 21 paisa. So it's going to be plus 0.21. And corresponding to here, it is 0.4. So you can add 40 cents. So it's going to be 67.8. So this is, sorry, I took opposite. For 1.0775, it's going to be 40 cents. And for 67.8, it's going to be 0.21. So 67.8 plus 0.21, that's what I think you get 68.1. And 1.0775 plus 40, is it 1.0815 plus 40 for the last 2 digits? That is the rate you get. Then multiply 68.101 into 1.0815. I think you get 73.4793. The cross rate is what you're trying to apply. And out of the 5 lakh euro what you receive, 50% will be in the EEFC account, which means that 50% will not be converted into rupees. Only balance 50%. So 2,50,000 will be converted into rupees. So 2,50,000 multiplied by 73.47. I hope you get approximately 1.83. Just check it. Is the numbers correct? 2,50,000 multiplied by 73.4793. Is it correct? Getting? That is what is the cash flow to the company, exchange difference, interest amount to be paid to bank by the company, that is uh, oh, this margin they have not applied. Oh, here only they have applied margin. Okay, okay. So what we should do is the number getting correct? 1 point. Okay, margin they've added here. I mean, they have considered margin here. We can consider margin the last step as well. So usually what institute does is wherever rupee involved, there they apply the exchange margin. That's the step they apply even in the cross rates, that is rupees involved here. So in this point they will apply margin, and you are taking a lower rate. Lower rate in the case of margin means even more lower rate, so you subtract, just extend the position. You can subtract it here or you can subtract on the final rate. The answer ultimately will remain same, that does not change. Okay, so and on this amount you can calculate the interest. Interest on post shipment credit is 8%. This is the letter of credit for which you have to pay interest to the banker. It's not interest actually, it's a commission kind of thing, because bank is giving a letter of credit for which you have to pay them commission. But anyway, they use the word interest. Let's go with that word interest on the amount of invoice, or on the amount you collect at 80 days at the rate of 8%. Just check it, is it coming? They're not showing the calculation. On 1.83 crore 69,825 multiplied by 80 by 365 multiplied by 80%. Will you get 3,22,101? Check it out. You're getting it? Same amount? Okay. Okay, so that is with respect to the forward hedging problem. That is an exam question in January 2021. Next. Yes. Which one? Margin. It apply for cross rate. Whether you do it at an intermediary stage or whether you apply in the last step, the answer will remain same. So what the convenience step they have taken is they have applied in one conversion during rupees. So mathematically, if you apply at the end also, it will still remain same. So you can check it out. You see, we will get how much? 67.8, 68.01 is what we get, multiplied by 1.07, 1.0815. This is what the other conversion rate to get the cross rates. Then we have to multiply it by this, whatever number you get. What do you get now here? 73.5528. Okay, now on this you apply margin money 0.1%, so subtract 0.1%, that is 0.7355, 0.7355. No, this, I mean this number only if I 1% if I take, subtract after that 73.48, 47 something. That's what these people have got it. So whether you apply the exchange rate on the last step or apply the exchange rate in the intermediate step, answer will remain same. But institute, while presenting the solutions, what they have taken is they have applied on the intermediary where rupee is involved. So that is the approach they have taken. The presentation you can either follow on net basis or on the rupee basis like this. Ultimate amount will be same. Correct. No, we will not pay 2 times because this is the cross rate only for calculation purpose. We are transacting with the bank only. While the bank giving you the code, they take help of the cross rate and give it to you. So transactions will not be 2 transactions. If 2 transactions involved, then margin will be there. But this cross rate is a notional 2 transaction. Just to connect the 2 intermediary currency, we take the help of the cross rates. But actual transactions will be only at the final stage. Okay, so this is forward hedging. Then we come to the options thing. So options, again I'll like to discuss some formats based quickly. This will not be helpful here, but still I would like to discuss that concept, and then we can go back to the table once more. The chart for that should be there. Okay, chart only should be there. Yes, let me search for that only. That must be there. For option hedging, yeah, currency option. The option where some people usually get confused is which option should we take, the call or put option. So follow these rules, you will be able to follow it. So first thing is identify the types of options. So for that, what you should do is look at the quotation. Quotation in the sense, they will tell you 1 pound equals $1.8, something like that. So when they mention like this, whatever on the left hand side, and that is your underlying asset. Identify first and underlying asset. Or they will tell you lot size. Lot size is 1000 euros, like that. The lot size is also the underlying asset. Then you identify if the underlying asset is purchased, then you go for call option. If underlying asset is sold, you go for the put option. Let me give an example. Let's say you're talking about an UK exporter, and the quotation given is like this: 1 pound equals $1.6. UK exporter having invoice of $5 lakh. Now, what is the underlying currency here? Underlying asset here. 1 pound equal to $1.6 means underlying is pounds, left hand side. Now, second thing, he is having $5 lakh euro, which he is going to receive from his customer. Once you receive the dollars, being a UK exporter, he has to convert the dollar into pounds, and for which, what is he doing, selling or buying? One currency is sold, one currency is purchased, but what we have to look at is from underlying asset point of view. Dollar you are giving, pound you are receiving. So thinking from dollar point of view, it is sale. If the underlying asset was dollar, it would have been a put option contract, but underlying asset here is pounds, pound you are getting, therefore it will be a call option contract. So the first step is to identify from the underlying point of view, are you purchasing or are you selling? If the underlying is purchased, it is call option. If the underlying is sold, it is put option. Then step 2, to decide the number of contracts. This will arise whenever there is a lot size implication. So if underlying asset and invoice are same, then very straightforward. Number of contract is whatever the invoice amount divided by lot size. So if invoice amount is $5 lakh, underlying asset is also dollars and dollars, then the number of contract will be like say $5 lakh, and one contract is $1 lakh. So 5 lakh by 1 lakh, you will say number of contract is 5. But the situation comes when the underlying asset is different, invoice amount is different. Like in this example, the underlying asset is in pounds, but invoice is in dollars. It basically happens whenever there is a indirect quote. So when the invoice is different currency, underlying is different currency, you have to do the same thing, but one extra step will come. What is the extra we did in the previous case? Invoice amount by lot size. Now also I do invoice amount by lot size, but that invoice amount is in different currency. I have to convert it. For conversion purpose, I'll make use of strike price. So strike price, what does it do? It will convert. Like in this case, it is $1.6 means $5 lakh divided by 1.6. So when you apply exchange rate, what will happen? The currency gets changed. So $5 lakh, when you divide by 1.6, the answer will be in pounds, which is what we require because lot size, underlying asset would be in pounds. Whenever the quote is indirect quote, this one extra step would apply. Ultimately, the cash flow on expiry date, just like what we did in derivative chapter, it will be number of contracts into lot size into strike price. This strike price you treat like a conversion rate, then your problem will get solved. So number of contracts into lot size into strike price. This is thinking that market price is exercised, and if it is exercised, then you take strike price. If it is not exercised, That information may be given at the end. Then you go for the market price or strike price, whichever is beneficial, because as a holder you will have a choice. And if you have a fractional round off thing, then you can go for the forward contract for that. Then because it's option contract, you have to pay premium. And how much you pay premium? Same formula, number of contracts, lot size multiplied by strike price. You don't multiply by strike price, you multiply it by premium. Be careful in this situation. For example, the premium you treat like a exchange rate. That's a shortcut. Treat premium as the same effect of exchange rate, in the sense, if $1 pound is $1.6 is the strike rate, and 1 pound is, let's say, $0.25 is the premium. Now how much premium you have to pay? Let's consider lot size as 50,000 pounds. In this case, how many number of contracts you are going to enter into? 5 lakh is the invoice amount. You can look at this. 5 lakh is the invoice amount divided by strike price, means divided by 1.6, and divided by lot size divided by 50 euros. So 5 lakh divided by 1.6 divided by 50,000. Okay, let's round it off to 6 contracts. So how are you going to calculate the premium then? Number of contract is 6 multiplied by lot size is 50,000 multiplied by premium 0.25. So 6 multiplied by 50,000 multiplied by 0.25 equals 75,000. Which currency? Euro or pounds? I mean euro or pounds? Yes. So dollar or pounds? We have taken 50,000 pounds, then multiplied by the premium. When you take a currency, apply the premium, treat it like an exchange rate. So when you start with pounds, apply exchange rate, the resulting will be another currency. Therefore, the resulting you get it is in dollars. So the answer cannot be in dollars, because the problem is from exporter point of view. The dollars has to be converted again into pounds. One extra step will come. Or you remember like this, whenever this situation applies, when the underlying asset and the invoice are different, in that case this one extra step will come, conversion of premium in foreign currency into local currency by applying the spot rate. Since interest premium is paid at the beginning, sometimes some people say time value of money to be considered, but mostly institute ignores it. So you can also ignore it. That is the choice. You can take it. That's not a problem. Main issues especially to be considered are identifying call and put option. That is confusion number 1. While understanding number of contracts, this step is second confusion. Third step will be this: when the premium is in foreign currency, you have to apply one extra step to convert the foreign currency into local currency. So if you have any doubts in this, please check it out. We'll take a problem on this after this. I mean, like margin means? No, you have to convert it, because the number of contracts and all will change. If you don't round off, will be in a different manner. I know some people do like lot size only, they will convert it to other currency and do it. I don't recommend that. When they give you lot size in pounds, keep it in pounds. Invoice is in dollars, keep it in dollars. You divide by the strike price, then this answer will be in pounds indirectly. But you have to apply the strike price. Same thing for premium. This answer, when you do number of contracts based on this, when the answer is in dollars, you have to apply the spot buy rate, and spot buy rate will be higher rate because you are buying, and this might be 1 pound equal to so much dollar, so dollar may be right hand side, and buying right hand side means 1 divided by lower rates. So all those consequences will follow if you remove the chain in between. That end value may not be appropriate. So just keep that same process. You multiply it by the premium, whatever the lot size, the other currency will be obtained. And if the other currency is foreign currency, one extra step will come. And when will this come? Whenever this invoice amount and underlying asset are different. Okay, so let's take up the problem on these options. Okay, before that, I think we should also discuss quickly the money market hedging parts. Let me explain that. What is this money market hedging? Okay, so process, try to understand, then the shortcut I'll give you. Today, customer has, the exporter has sold goods to customer, and after 3 months, let's say after due date, the customer will receive dollars from the exporter, and that dollar what exporter has received, if you sell in the currency market, that is uncertain, there is risk. You sell in the forward market at a forward rate, that's called as forward hedging. Instead of that, you are going to use money market hedging. That means you use the concept of borrowing and deposit. So what you do is, you have a dollar receivable after 3 months. Now you are going to create a liability. That is, you have like an assets, and therefore you create a liability. So when the liability in borrowing USD happens, after maturity, you will have USD loan and you will have USD asset, and that you will repay, so that will set off. That is, you don't require any conversion rate on the expiry. But while calculating the present value, while calculating this borrowing, make sure it is present value of the invoice amount. Why present value of the invoice amount? Because when you add interest, it should perfectly match the invoice amount. So the invoice amount and the borrowing repayment will be perfectly matched. Those two can be set off. And what you do with that borrowing in USD you are going to convert into rupees in the spot market by selling it, and that rupees what you have, you are going to deposit. So ultimately what is it? You deposit, you mature, and that is the amount of money market hedging maturity amount under export contract. This is one thing, but if you carefully observe, we are on one hand doing a present value, on the other hand we are compounding it. We are discounting also, we are compounding also, and it is nothing but application of IRPT theorem formula. So I have given a shortcut like this. You start with invoice amounts. Being an exporter, you apply spot sell rate, then you do IRPT formula, 1 plus local by 1 plus foreign. You get the answer. And how do you know whether it is a foreign deposit or a foreign borrowing? Very simple, straightforward. You are an exporter. Exporter means you will have an asset. So numerator you make it as asset, denominator you make it as borrowing, opposite. But you get the answer in one line, but I don't recommend you to present like this in one line, because you don't get the marks. Because marks is not given by the answer. Marks is given by for the process you follow, steps you follow. But detailed step also not required. See, you can see steps also I have given. First you start with the denominator 1. Then you go left side, spot sell. Then you go right side. In the sense, first you compute the present value of the borrowing. Then you convert it into spot sell. Spot sell means lower rate, that is our second step. Then whatever the money you receive, you are going to deposit, and final maturity amount is the step. Same thing you apply for the import transaction. Import means invoice amount will be starting. It's going to be spot. buy rate because importer needs to buy. Then we are going to do 1 plus foreign deposit, 1 plus local. When 1 plus local by 1 plus foreign, that is IRPT formula. Then because it's importer, importer means you will write borrowing, opposite of the borrowing will be deposit. That's the formula. But don't write that answer, one line answer, you don't get marks. So what you should do is, you do first step is to take the denominator, that is invoice amount, divided by 1 plus foreign deposit, the one what I have written. That will be the first step. Second step, you do the spot rate, that much of dollar you are going to buy. And second thing, whatever the money required in rupees, you are going to borrow. So that is the three steps. You know, the present value of loan, deposit, first step, spot buy that much money, second step, borrow so much of money to buy the dollars, third step. So this shortcut only convert it into three steps and present in the exam, you get the marks. So this money market hedging as well as option hedging will apply it in one problem. So problem number 10, May 2019, exam question. Sun Limited, Indian company needs $5 lakh in 90 days. In this connection, the following information is given below. Spot rate $1 is 71. 90-day forward rate $1 is 73. Interest rates given. 90-day deposit borrowing US India. A call option on dollar that expires in 90 days as an exercise price of 74, premium of 0.1. Sun Limited has forecasted the spot rates for 90 days given below. Future rate probability given. With the help of the which of the following strategies would be most preferable? A forward contract, money market hedge, option contract, no hedging. Show calculation in each case. They were worried whether you tick one of them in multiple choice and you close the answer, because which of the following is profitable, you click one and close it. So they were worried. So they said show calculation in each case. Okay, so the forward contract means it is a forward Indian company need $5 lakh. So they are going to buy. They need the dollars. They are going to buy. It's going to be forward buy, only one rate. But even if they are given multiple rates, you would be purchasing at a higher rate. The rate applicable is forward rate 73. So 5 lakh multiplied by 73. That you are done with the first one. Money market hedge. This is you are going to purchase means like an importer. So you write the IRPT formula first. That is going to be the spot rate into 1 plus local. In this case, local is rupees divided by 1 plus foreign, which is dollars. And because importer, so you always start with invoice amount. Importer means it's going to be spot buy rate. And importer will have a loan, so numerator will be liability, means rupee will be borrowing, and opposite dollar will be deposit. And what are the steps you are going to write in the exam? First step, the invoice amount divided by 1 plus dollar deposit rate. That is going to be the first step. This is the amount of deposit in dollar required. You don't have to give too much of details. Just show one calculation, and whatever you're doing, give a description kind of thing. Present value of invoice amount, something like that. You don't have to give too much details also, like a narration in journal entry. Second step, you are going to buy. So whatever the amount you just calculated now, you just say that spot buy in market. That much is sufficient. Second step. Third step, you are going to borrow and repay. So third step is borrowing in rupees and repayable. Whatever the amount you got so far into 1 plus rupee borrowing, that's how you get. I mean, I've written one line here, but in the exam you should give the 3 separate stages of calculations. That is money market hedge. Come to option contract. First thing in the option contract, we need to identify whether it is call option or put option. Luckily in the problem they said directly call option, but let's make sure we apply the same logic. In the sense, what is the underlying assets? They have given $1 and the strike price is excise price of 74 rupees. So $1 is rupees 74. So what will be the underlying assets? That would be dollars. And therefore what we are going to do, because we are going to purchase the dollars, and dollar point of view only you should think, therefore purchase dollar means it will be a call option. If the underlying asset was rupees, if the lot size was 10 lakh rupees, then how would you analyze the dollar I'm going to purchase, the rupee I'm going to give, and from rupee point of view means I'm going to sell, so it would be a put option if underlying asset was rupees. Lot size and all not given, so no need to worry about the number of contracts. You assume one contract is 1 unit, so no need to worry about any number of contracts. You can directly take invoice amount or entire amount as one contract. So let's take the option. What and all you have to do. Okay, I've written here. Underlying asset dollar, translation currency receive dollars, applicable option call option, premium on 5 lakh dollar into 0.1. Look at the basics. 5 lakh dollars. When you apply the exchange rate, you get the rupees. If the underlying asset was rupee, then what would have happened? This premium, the answer, you would have got it in dollar terms. And this requires one extra step of converting from foreign currency into local currency. It did not happen. It may happen. And then B, interest on premium. This again may be considered, may not be considered. The institute usually ignores it, so you can also take it out. But I have considered it because premium is payable at the beginning, whereas all the other cash flows are taking place on expiry. So time value of money is there. I have applied Indian borrowing rate, which is 6% for a period of that 3 months. Okay, on expiry date, you have to be a little bit more careful because you see they have given some expected rates. So you cannot directly take a 72.5 into 25, 73 into 50, 74.5 into 25 because in each case, it may be exercised, it may not be exercised. You have to calculate under each case. So the future rate is like a market price on expiry. And what is the strike rate? Strike price is 74. And you see in the first case, it is more or less. The market price is less, which means the option is not exercised, which basically means you go to market and buy it, not in the options. Your buy rate is 72.5. If it is 74, again a call option not exercised, you go to market at the lower rate and buy. If it is 74.5, yes, you will exercise. Here your price will be 74. So in the first two cases, your buy rate will be market rate 72.5, 73 because option not exercised. In the last situation, the market rate is 74. I mean market rate 74.5, but you don't buy in the market high rate. You exercise this option, come here at 74. So the rates are 72.5, 73 and 74. 72.5, 73 and 74. Then you multiply that by 5 lakh, or you could have done multiplied by probability, you get the net amount, then you multiply by 5 lakh. One shot you can do. They have done it one by one. 72.5 into 5 lakh, 73 into 5 lakh. In last case, it's not exercised. I mean, not going to market, it is exercised. So you take the strike rate 74 into 5 lakh and total amount. You could have done like this also. You could have done 72.5 into 0.25, 73 into 0.5. 74 into 0.25, you get per dollar, then multiplied by 5 lakh. At one shot you get. That is also fine. Last situation, no hedging. No hedging means you are going for the rate prevailing on the spot rate based on the expectation. This you can do. 72.5 into 0.25, 73 into 0.5, 74.5 into 0.25. You get one expected rate multiplied by 5 lakh. You get the cash flow. And being an importer, you would like whichever is less. So which would be the lowest number is 3.65. So we recommend forward hedging. Forward coverage is the cheapest, the most beneficial. Okay, so take a look at this problem and solution. See if you have any doubt. Money market calculation. I've done just one calculation. The exam, you have to write 3 steps. The first step is 5 lakh dollar divided by 1.025. Second step is multiply that dollar by spot buy. And the third step, whatever that number multiplied by, this is okay, rupees, no, I think I'll put pounds in, let me just change it. This is going to be foreign, in this case foreign is dollar, and deposits, for local borrowing, local is rupees, deposit is dollar. So dollar deposits first step, spot buy second step, rupee borrowing third step. Interest on premium is mandatory in every case? No, as I told you, institute does not consider. That's what I would do it, interest on premium, because I believe in time value of money. In the examination context, I say don't write it, because institute, in most of the solution at least, the interest on premium they don't consider. So it's recommended you also don't do it. Let's just match the institute solution. Okay, done. This is with respect to option hedging. A similar one, most popular one, again from exam point of view, so many times they ask, is currency future hedging. Let me talk about the steps quickly, then we will look at the problem. Okay, so currency futures, the initial steps are same as option, in the sense you are going to look at one unit equal to so many units, that is your left hand side is underlying, or they give you lot size, that is your underlying. If you are purchasing the underlying, the transaction is future buy. In case of option, it was call option. If the underlying asset is sold, it is going to be future sell. In case of option, it was put option. And this also will be same step, that is number of contracts will be invoice amount divided by lot size into future rate. There we take the strike price. Anyway, here we take the invoice amount divided by lot size into the future rate. Then we will have the initial margin. Now, this is the new thing which is not there, because in case of options, margin will not come, premium will come. Here margin, but again repeat, initial margin is not your expense. Initial margin is only a deposit. What you need to consider, the interest element, we'll consider in the next step. It is just a deposit amount. The impact is opportunity cost. Number of contracts multiplied by margin per contract, there will be the initial margin, and this is what ultimately required. Cash flows in expiry, and easiest way to remember, again, as I told you earlier, in spot market S, in future market F, in money market M, SFM. Remember those three transactions. In spot market, what do you do? Whatever the invoice amount, you are going to sell in the spot market. Remember, it's not spot market now, it is spot market on expiry. And when will you come to know this rate? Only on expiry. Then how do you know whether you should go for this method or not? In practically, we don't know. Only in exam hall we will know, because exam hall they will give you the rates. So this is most like a post-mortem analysis rather than decision making process. So this is known only on that date. So we are calculating the effective cash flow after the event have taken place. So invoice into spot rates, that is the rate prevailing on expiry date. In future market, whatever the transaction we had entered into earlier, you see, if it was future buy, now we are going to do future sell and square off. Earlier we had entered the position, now we are going to exit the position, opposite of this transaction. If it was future buy earlier, here I'm going to do square off by doing future sell. Ultimately, FS minus FB, future sell minus future buy, difference between the entry rate and exit rate multiplied by lot size multiplied by number of contracts. If the results in foreign currency, then you have one more step to convert it in spot rate. We'll explain the problem. I'll explain this process. Initial margin, I told you, margin is not your expense. On the margin, it is a deposit, comes back later, but your opportunity cost, interest, is the expense to be considered. In spot market, invoice amount is sold or executed. In future market, whatever the contract you entered earlier, that would be square off. And in money market, on the margin, you are going to pay interest. These are the three cash flows that will be considered in currency future hedging. Let's take a problem to understand this. DSC Limited is an export-oriented business in Kolkata. DSC Limited invoices in customer currency. The receipt is US dollar due on July 1st. Market information is given. Look at the exchange rate. It is US dollar / rupees, which means it is 1 rupee equals so much of US dollars. Or you can see what is the contract size. Rupees 6,40,000. Therefore, underlying asset is rupees. Initial margin, April, July. On July, spot rate, currency future rate. Comment which of the following would be a most advantageous. It may assume that variation margin be settled on the maturity of the future contract. Okay. First, we go for the forward contract. Forward contract means we are going to receive the money from customer on 1st of July, and we are on April 1st. So April 1st to July 1st, April, May, June. 3 months forward contract you have to go. So rate applicable is 0.0147. So what is the rate? This 1 rupee equals 0.0147 dollars. And what invoice we have here? US dollar, which means it is right hand side. Therefore, you should divide. So 3 lakh by 0.0147, and we have it dollar. When you apply the exchange rate, the result will be in rupees. Now look at this. As I just told you, underlying asset is rupees. So what transaction you are going to do? Think from rupee point of view. This is an export oriented business. So you receive dollar from your customer, and that dollar you have to give it to the bank, and you receive money, rupees. So if you think from dollar point of view, dollar is going out to the bank, but rupee point of view, your rupee, you are getting it. So underlying asset is rupee. Think from rupee point of view, it is rupee coming in, purchase. If it was option, I would have gone for call option. In this case, I will go for future buy contract. On expiry date, I am going to do future sell so that this will be squared off. So at what rate do I go for it? Do I go for April future, or do I go for July future? The money to be received in the month of July, so I should go for the July futures. And how do you calculate the number of contracts? The formula for number of contract is invoice amount divided by lot size. But what is the invoice amount? $3 lakh. What is the lot size? Rupees. Not matching. You remember what we have supposed to do in options? Numerator invoice, denominator lot size. But if they are in different currency, I need to convert it to by using the strike price in case of option, and in case of here future, I'll convert it using future rate. The future rate is 0.0151. So how do you calculate the number of contracts? It will be invoice amount $3 lakh divided by the lot size, which is 6,40,000. But I can't divide by 6,40,000 because it is rupees. So you apply the conversion rate 0.0151. So 3 lakh divided by 6,40,000 divided by 0.0151. 31 contracts. So 31 contract is the number of contracts to be entered into. And what is the lot size? I mean, the initial margin. The margin is always given per contract basis. They have not specified, understood. This is per contract. We are not going for April margin. We go for July. So margin amount is 24,000 multiplied by 31 contract. That table is implied per contract. Margin per contract. On July 1st, 3 transaction in spot market, in future market, in money market, SFM. In spot market, the rate they have given the last line on the paragraph. In spot market, the rate is 0.0146. So $3 lakh divided by right hand side 0.0146 will be the receipts in spot market. In money market, interest you are going to pay. In future market, you are going to do set off. I mean square off. What rate you are going to square off? Earlier we have entered into future buy at 0.0151, and now I'm going to do future sell at 0.0147. 0.0147 selling at a lower rate, which means I think here I get a loss. Profit. Oh, rupee was future buy or future sell? Rupee was coming only, no? Coming in, exporter. No, actually, it's a loss. It's an institute mistake. They have taken as profit, I think, right? See, they have written correctly. Buy at 151, sell at 147. They have written correct. Then they have become profit. In my world, at least, when the sell rate is less, it is loss. So it's not profit, it's loss. Institute solution I have taken as it is. It's a mistake for sure. It is loss, not profit. Buy at 151. Yeah. Then sell at 147. So indirectly, if you see that rupee has been depreciated. Yeah, rupee. Yeah, it's fine. So 151 you buy, 147 you sell. It's a loss, not a profit. It's a definitely a mistake. So you get a difference of 0.0147 you are selling, 0.0151 you are buying. That difference you multiplied by lot size, which is 31 contract into lot size is 6,40,000. So the answer will be in dollars or rupees. 6,40,000 was rupees. This is like exchange rate, therefore answer will be in dollars. And this dollars is what they have calculated as 7936, and this dollar is going to be a loss, so I need to buy this dollars at a higher rate. Anyway, only one rate is given. The spot rate is 0.0146. So divide this 7936 by 0.0146, you get 5,43,562. This is outflow, loss. This is inflow. And margin, that is 31 contract, 24,000 into 31, on that 8.5% rate of interest for 3 months. This is always a payment. This is also a loss. This is outflow. So this amount is actually not correct. Oh, okay. I have written this also. Okay. Okay. This is the comment I have written. I mean, institute has not given. This was my comment in my book. So anyway, so this number would be 2.05 minus 5, so 2 lakh minus 15. I think 1 point something you get, I think. Right? 2 lakh 5 minus 5. It's 1.9 minus this. I think 1.98 something. Yeah. So 1.9 something you get, 1.9 crores. Almost 2 crores, rounding it off. Whichever is beneficial, the highest would be forward hedging. This is, I think highest would be unhedged amount. 205. Yeah, the answer also will change, but anyway, 20547. This would be the highest answer. Yes, that would be the answer. Anyway, this was a mistake in the institute solution. Can't help. Sometimes when you copy paste and they don't change the numbers, institute also they can do like this. I hope they have not valued the paper like this. This is the given in suggest answers. Anyway, so this is the currency future. Hedging, this kind of question is very popular. Take a look at the solution. See if you have any doubt. Okay. Next, one more area. Again, sometimes they ask in examination. So let's take a look at the problem directly. This is called as the nostro, vostro, and loro account. Nostro account means or nostro, vostro is just two sides of same coin. When we maintain a foreign currency, it's like our account with them or their account with us. That's what is called as the nostro, vostro. When we maintain the foreign currency, nostro. When they maintain with us, it is vostro. And when we make use of a third party bank, because in some country there might be some restrictions, so we make help of intermediary bank to enter into one new country, that is called as loro account. That is their account with them. Anyway, let's look at the problem which they ask in exams. Like it happened in 2018. A dealer in foreign exchange has the following position in Swiss franc on 31st Jan. Balance in nostro account credit. Opening position overbought, purchased a bill on Zurich, sold forward TT for telegraphic transfer, now with electronic transfer. Forward purchase contract cancelled, remittance by TT, draft on Zurich cancelled. Examine what steps would the dealer take if he is required to maintain credit balance of Swiss franc 30,000 in nostro account and keep a overbought position on Swiss franc 10,000. So there are two things they are asking. One is the nostro accounts. The nostro account you understand like a bank balance. This is actually cash position, whereas this overbought position is just a ledger or just a statement. Just a statement because you are listing out how many forward contracts have entered into and how many forward sell and forward buy contracts have entered into. I have not executed. Overbought, overjust position is just difference between the forward buy contract and forward sell contract. How many purchase contracts, how many sale contracts. I have not sold yet, I have not purchased yet. I am going to purchase, I am going to sold. So overbought position is just a list of how much I could get if the contract is executed, whereas actual cash balance is nostro account. So opening balance, what you have in nostro account, they said 1 lakh. So you think like a passbook kind of thing. You're having a opening balance of 1 lakh. Cash balance, you have credit of your bank account 1 lakh. Next transaction, opening position overbought. This is the contract you're having. Opening position overbought means number of purchases are more than the number of sale contract. You have more purchases, 50,000. Purchased a bill on Zurich, 70,000. You purchased a bill means you have entered into forward buy contract. So 70,000 will come in the buy column, purchase column. Purchased a bill, forward buy. You have entered into forward buy contract. Purchases, so you have entered into a forward buy contract. Sold a forward TT, telegraphic transfer, 49,000. Means you have entered into a forward sale contract. It will come in the sales side. Sold is also done. Forward purchase contract cancelled. It was like earlier you entered into one purchase contract, now it is cancelled. It is like purchase returns. So where was the purchase column? You would have written on the purchase side. Now purchase cancelled means you write on the sales side. It's like a purchase return, opposite of purchases. Your purchase is reduced to that extent. Forward purchase contract cancelled. Remittance by TT means you have remitted, you have given. When you remit, your cash balance will come down. And when you remit, your forward contract or exchange position also will come down. The exchange position is actually the cash position plus forward contracts. So both of them is reflected in exchange position. So a transaction in cash account will come in exchange position also. But a transaction in exchange position need not always come in the cash position. So when you remit, your balance will come down. So 75,000 is taken to the negative side, and when you remit, it is going out from your forward contract, going out from your exchange position. So there also you will subtract. Draft on Zurich cancel. So this is like opposite of previous forward contract. This is like a sales word you made, draft you have issued, now it is coming back. It is like a sales returns. So sales returns means it will be written on the purchases side. That is what is draft cancelled, forward contract, forward sale contract cancelled. That's what the draft on Zurich cancelled means. That's the terminology they use. When they use draft on Zurich, because it's about a Swiss franc, so you are giving the Swiss franc. It's like when they say bank and they say commission. Is it income you take or expense you take? Normally, when I say bank commission, I'll take it as income. Normally, so similarly, when you say draft on a currency in which you are dealing with the account, we treat the draft as draft given. It's like a forward sale contract, and it is cancelled means now you're going to take it as a purchase opposite. So draft in this context you remember like a sale, and draft cancelled you treat it like a sales returns. So then they want to maintain a Swiss francs of 30,000 in Nostro account. So at this point in time, if you calculate, I think you will have only how much, 25,000 balance, but you have to maintain a balance of 30,000. So if you have to maintain 30,000 balance, that means you need to buy 5,000 more. And if you have to buy 5,000 more, that will come in cash account, and that will also come in the exchange position account. So I think 1,65,000, 1,65,000, this account is nullified, but this is not sufficient. You have to again enter into they want to maintain a balance of 10,000, so you are going to additionally enter into purchase position or buy forward 10,000 Swiss franc. So cash you are going to purchase 5,000, forward you are going to enter into contract for 10,000. That is going to fulfill your target. Yeah, basically whatever you are, you're going to purchase here, 10,000 here and 5,000 balance here. Yes. So take a look at this, see if you have any other question. It's the I mean Switzerland, Swiss. The name city there is Zurich. Just like I use the word bill on Zurich, we have interpreted as it is a purchase. A draft on Zurich will take it as sales, and draft on Zurich cancelled, so it coming again in the purchase column. So that bill and draft is the opposite terms. Okay, so one more problem on the foreign exchange. A US investor to invest Sensex for a period of 1 year. The relevant information is given. Size of investment in dollars, spot rate 1 year ago, spot rate now, Sensex 1 year ago. Okay, sorry, one question is coming. Overbought position 10,000. What happened to that? That is still overbought position. They want to maintain a overbought position. They want to keep that. But at this point in time, you see that purchase and sale was zero. So the number of purchase contracts, number of sale contracts was equal. So it was nullified. But you want to maintain a net balance of 10,000. So you are going to enter into a forward contract to 10,000. So when you enter into a forward contract of 10,000 forward buy, you end up in overbought position of 10,000. Okay, so I hope it is fine. Size of investments 1 year ago, spot rate now, 1 year ago, Sensex now, inflation in US, inflation in India. Compute the nominal rate of return to US investor, compute the real depreciation or appreciation of rupee, what should be the exchange rate, if relevant purchasing power parity holds good, what will be the real returns to Indian investor in Sensex. Okay, what is the nominal rate of return to US investors? Just 1 second, see if I have just shown slightly differently. Okay. What is the nominal rate of return to US investors? So one small concept is there. What is this nominal rate and what is this real rate? So we usually use say like this, the real rate plus inflation, I mean not conceptually, not mathematically, is what we call it as nominal. In the sense, nominal means your, let's say, FD interest rates. But you know, when income increases, your expense also will increase. That's what you are having, inflation. So your real growth in terms of standard of living or salary is from the salary increase, you should subtract the expense increase. The remaining is what is called as the real rate. So nominal rate means with inflation, a real rate means after removing the impact of inflation. So here nominal rate of return to US investor. Nominal rate means as it is, how much rate they've actually got it. So you can understand like this formats. Maybe I'll show here. This format is easy to follow, so you may have to choose this format. Will be easy for you to follow. Just try to understand. The format I apply is this. What is the amount of investment you made? After 1 year, how much it became, and therefore what is the change? What is the amount of investment that is taking place? Size of investment $20 lakh, so it is $20 lakh. And when you invested, the rate was 42.5. Why should you take 42.5? Why not 42.6? You are selling the dollar and investing in the US. You are converting, or you need the you are going to, this is invested where? US investor choose to invest in the Sensex. So US person came with the dollar and he converted into cash. Therefore dollar would have been sold, and sold at a lower rate. But if the same question was reversed, had Indian person went to US and invested the same dollar, so if he wants to purchase $20 lakh, you would have purchased at 42.6. Just keep that in mind. It is US investor coming to India, so he's selling the dollar and investing in India in rupees. If Indian investor was investing in US, then he would have converted the rupee into dollar. So he would have purchased the dollar first. It would have been a higher rate. Anyway, here 42.5. So 8,50,000 rupee is what totally he has invested. And the Sensex at that point in time was 3256. So can I say like this then, number of units 8,50,000 rupee divided by 3256 price per unit, number of units is 26,106. This is the number of units. I'm not saying number of shares because it's a index, number of units. And this is the number of units you have now as well, 26,106. And what happened to Sensex? 3256 has become 3765. So what you are going to do, this 26106 you multiply it by 3765, and therefore the amount would have become like 9.82 crore rupees. So he has invested, the inflow is 9.82 crores, and what will he do? He will take this back to dollar, to his country. So this rupee will be converted to dollar, means rupee should be sold, dollar need to be purchased. So you are going to divide it. Which rate are you going to do? You can think either from rupee point of view or from dollar point of view. Both answer will be same, but do not think from both the point of view. Spot rate now we have 43.85 and 43.9. If you think, let's say from dollar point of view, what you're doing with respect to dollar, now you're going to purchase. So you purchase at a higher rate, 43.9. Or if you think that no, I have rupees, and rupee is what I'm going to convert. You see, I have 9.82 crore rupees something. So I'm going to sell rupees. Think like that, no problem. You're selling rupees, right hand side, you're dividing, and dividing, selling means selling at a lower rate, and lower rate in this case will be 1 divided by higher rate, because you're dividing it. So that case also 1 by 43.9, same answer will come. So dollar ultimately come to 23,38,931. So 20 lakh is invested. Now it became 22 lakh 38. So the return therefore is 11.94%. If you understand mathematically what is it really happening, just for understanding purpose, they have not asked, but I'll go with one step further. Just observe this. What is the returns in the Sensex? 3256 has become 3765. So what is the return here? You know the formula, like P1 minus P0 by P0. 3765 minus 3256 by 3256 into 100. 15.63. Okay, this is the return they have got. But this is not the only return we can consider, because there is also a exchange rate fluctuation which will influence your returns. So what is that happen to? 43.9 minus 42.5 divided by 42.5 into 100. 3.29. Now 15.63 is what is their returns, but while taking the dollar appreciated, so they are lost, because it's their asset, it is lost. So 15.63 subtract 3.29 approximately will be 11.94. it will not be exact because of mathematical reasons. We can reconcile, but not record at this point. So 11.94, let's say 12%. 3.29, 12 minus 11.94, sorry, 15.63 minus 3.29, approximately around 11.912. Yeah, the difference because of that mathematical reason. But conceptually, why is he getting lesser than 15 is because of the rupee appreciation. The dollar appreciation, rupee became depreciated. 42.5 became 43.9. So dollar appreciated, so their value was lost. Anyway, so there are two impact is what I'm trying to tell. One is the return in Indian terms, and then the exchange rate fluctuation. Both of them together is the net return for the US investor. Same thing for Indian investor as well. If we go to US, one return what we get is in US returns, but while coming back, we should also take care of the exchange rate fluctuations. Then only my returns will be comparable with their returns. Anyway, that's first part of the question. Compute the real depreciation or appreciation of rupee. That's what we calculate, I think. Yeah, what we calculate is the percentage, but this should be adjusted for inflation. So what is that rate we calculated? This we have calculated. Yeah, real appreciation. We calculated this number, I believe, how much we calculated as 3.29%. Anyway, that is the actual inflation or the actual exchange fluctuation. We want to calculate the real appreciation or depreciation in rupees. So what you do is this. Take a look at this one. Today rate was 42.5. The exchange rate, and today rate means in the given problem 1 year back 42.5, and after 1 year it became 43.85. So for that you adjust for the inflation. The sense for 43.85 you apply 5% inflation and divide by 9% inflation. 5%, 9% are the inflation rates in US and India. You're going backwards basically. If this was the forward rate, what is supposed to be the actual rates? If 43.85 was the forward rates, what was supposed to be the spot rate? You know, we call it as like deflating something or finding real value of something. This I'm going to remove the effect of inflation. So I divide by opposite of IRPT theorem. I divide by 1 plus local rate, I multiplied by 1 plus inflation. So it was supposed to be 42.24 if I remove the impact of inflation. But what was earlier? 42.5, and it is 42.24. Therefore, the real rate is minus 0.61. If I have to explain in one more manner, I'll explain this. See if you're able to understand this point. I'll try to explain slightly differently. Suppose your salary like this, okay? Your salary was 1 lakh per month. And your salary became, let's say, 2 lakh per month. 2 lakh per month. Now, what is the nominal increase? 1 lakh became 2 lakh, so nominal increase is say 100%. 1 lakh doubled, 100%. But the real increase, you know what you should do? This 2 lakh, I should convert it into this number for me to say what is the real increase. Real increase in the terms of my existing salary. So 2 lakh I should divide by, if inflation, let's say 100 rupee was there, inflation is 8, this would be 108. So what should I do then? If I want to know the real value, I will divide by 1 plus 0.08. This will give me the salary not in today terms, this will give me the salary in real terms. 1 year back, what would be the number? Whatever the amount you get, 1 lakh something you get, 1,85,000. So my real increase is 85%. That's how I can compare the real salary growth. So that's what even say. One more example I'll give. If you put the money in fixed deposit today, 100 rupees let's say, or let's say 1,000 rupees, how much interest rate you get in FD as of now today? Let's say 5%. That means it becomes how much after 1 year? 1,050. Now 1,050 is your money with you, but this value would have been depreciated because of inflation. So if I want to know what is today value, let's say inflation is 7%. So that means if you have 100 rupees, that value now would have become 108. So 1050, convert this to 100. So how do you do it? 1050 divided by 108 into 100. You are deflating it. Take out the impact of inflation. 900 something, 972, which means your money is lost. We call negative interest rate, which is happening right now actually in our country. Not only in our country, throughout the world. Inflation, we are peaking at 8, 9, 10%. And the FD rate we are having at 5-6%. So even if you keep the money in FD, your money is getting reduced, getting depreciated because of the impact of inflation. So what I am trying to do here is computing the real value, means what is the rate we are having after, I mean you can take any of these rates. This is today, and this is 1 year later. The rate 1 year later, I will take, let's say 43.9, and this rate I'm going to convert it in what would be the rate 1 year back, the equivalent rate. So what I would have done, normally IRPT theorem, I'll multiply it by 1 plus local divided by 1 plus foreign. But while going backwards, I should do inverse. 1 plus foreign by 1 plus local. That's what I would have done here. I've taken 43.85, applied 1 plus foreign, divided by 1 plus local. I got 52.24 as against 52.5. So actual real rate is negative. The dollar real rate is negative, minus 0.61, and that is what this part of the question, which is real rate. Okay, they have done, yeah, they have done that's what they have done. Or if you want to understand the formula like this, you can do like this. The real rate of depreciation is you take the after 1 year rates, after 1 year spot rate, then you do opposites. That is multiplied by 1 plus foreign divided by 1 plus local. No, reading room is not here. It's there in this road. You just go down the road. Just before you enter the main road, on right side, you have to go there. There you have reading. So it is just like what you're doing in the IRPT theorem, but reverse it. You know what you do in IRPT theorem? From the spot rate, you are going to calculate the forward rate. Here what I'm doing, from the forward rates, I'm coming back and calculating the spot rate. And this whatever number you calculate, what you have, compare it with the spot rate. This difference is what is going to be called as the real, whatever real rate, real appreciation or depreciation, whatever it is. Okay, so that's second part of the question. Third part of the question is what should be the exchange rate if purchasing power parity holds good? Okay, this you know, spot rate multiplied by 1 plus local by 1 plus foreign for buying separately, selling separately. Applying IRPT theorem, Indian inflation, US inflation, you get the, not IRPT, purchasing power parity. What will be the real return to Indian investor in Sensex? So it is only from real return point of view. So what is the return? I think we already calculated this, no, this number. 15.63%. Now this number, you take out the inflation or the formula I told you, right? Real plus inflation equal to nominal. Of course, this is conceptually. If you need mathematically, what will you do? 1 plus real into 1 plus inflation equals 1 plus nominal. Everything 1 plus, because we follow mathematical multiplicative model. So inflation rate is in India is how much? 9%. So 0.09, and 1 plus nominal rate, that is the Sensex returns what we got, 15.63%. So 0.1563. So it will be 1 by 1.1563 divided by 1.09. 1 goes to right side, becomes -1. I think you get around 6.08%. That's what they have calculated here. But without that mathematical part, do it intuitively. How much return from the Sensex you have got? Around 15%. And how much inflation you are giving up out of 15? 9%. 6% is your real returns. So approximately real return is whatever is your nominal return minus inflation. That's what I was referring to. In the present situation, we are suffering now. Nominal rate in the world is less. FD rate is 5-6%. Inflation is 8%. That means we are losing. Our negative interest rate is going on now, which is a cause of concern. And that is why the Fed rates, even RBI, likely to increase the interest rates. So when they increase interest rate, inflation is high. Hopefully when they increase the interest rate, inflation will come down and the nominal will increase, so the gap at least would be reduced. That is their target, but we don't know whether it will happen or not. Anyway, real rate is difference between nominal inflation, so that way it's a very interesting problem, so I have included here. Okay, see if you have any other doubts, else we'll take a break and then we go to the one more foreign exchange chapter only, international financial management chapter. Which part of the question this is? Second part of the question there. Okay. Let's say we are taking 43.85. This, if we'll take today and after 1 year, this was 42.5 here and here 43.85. What normally we used to do is this 42.5 I used to calculate the rate after 1 year applying IRPT theorem and compare with this and say that arbitrage opportunity exists and all. But here what we are doing is this 43.85 I am going back, discounting and compounding, because both will be there in IRPT theorem. So it's a reverse of IRPT. In IRPT what would I have done? I compound by 1 plus local a discount by 1 plus foreign. This is what I do in IRPT, but I'm going reverse. So 1 plus foreign by 1 plus local. So this will give me what is supposed to be the rate historically. Then compare with the actual rate. The difference will give me the real appreciation or depreciation of rupee adjusted for inflation. Okay, so any other doubt on this point? Again, as I told you, take care of the old syllabus question papers. That's what I've been doing. Whichever question I thought would be interesting to discuss, I've included here. But it would be nice, it would be useful if you also go through the last 3-4 attempts old syllabus question papers. Because these are the usual questions we don't even solve in our regular classes. Not only me, anybody don't solve, but examination knows those are the question to select. So the best way for our to prepare is look at the previous question paper. At least those things, let's be prepared. If something new comes that we can't do anything, that's out of our hands. At least whatever has come, let's be prepared with that. And also is a test of a selection for me, because when stock market, when I pick a stock, profit or loss will tell me whether I've picked the right stock or not. Here we have selected these many questions. Only exam will tell me whether out of these questions, how many questions have actually come. I'll do the post-mortem analysis after the exams. Let's see, out of these 2 days what we are doing, how many questions have actually come in the exam. Ultimately, that is the test. At least similar concepts, similar problems, some areas at least should come. Okay, so I think that would be the foreign exchange. Again, don't get relaxation, because the next chapter what we are going to do is again connected with foreign exchange. That is going to be international financial management. Comprehensive book covers old syllabus question papers. Yes, absolutely. Oh, the book which we have given for solutions, comprehensive book covers old syllabus relevant questions and solution. Yes, definitely. But whichever important, I've included in this material also. So if you are looking towards the examination, I don't recommend you to buy any new book. Just go through this material at least. Okay, so let's take a break of 15 minutes. 12:15 we'll meet, and then we can go to the next chapter. Okay, 12:15 we'll meet, 15 minutes. Okay, so moving on to the next chapter, international financial management. So what type of question you can expect in exam? One is on that ADR GDR question. I'm not covering it, it's much easier, you can just go through it. And mainly there are two types of, or let's say three types of problem you can ask. One is foreign company coming into India, the other Indian company going outside India, and the other one is some surplus fund management, working capital management problems. This is the three variety problem I would expect. So let us take a look at those problems. Okay. Now foreign company coming to India, you will have to face some things like repatriation and all. But this one problem which has been coming in the exam so many times. You can see the heading also I've given in the examination. This variety is asked also quite a few times. It's actually a regular capital budgeting problem. But anyway, let's read it. A multinational company is planning to set up subsidiary in India where hitherto it was exporting in view of growing demand for its product and competition from other MNCs. They want to come to India. The initial project cost consisting of plant and machinery including installation is US dollar 500 million, which is nothing but your investment. Net working capital requirements are estimated to be 50 million. Working capital is also an investment. But what is the difference? This investment in plant and machinery, what you're doing, it will come back to you as after useful life, and that is called as scrap value, residual value. But this working capital also will come to you as it is at the end of useful life. It means when the project life is over. There is nothing called as a residual value, and they will not specify this in the problem directly. So working capital will be investment initially, and recovery of working capital will be inflow when the project is completed. The company follows straight line method of depreciation. Presently, the company is exporting 2 million units every year. Unit price of $80. Its variable cost per unit is 40. The chief financial officer has estimated the following operating cost and other data in respect of the proposed project. Variable operating cost 20 million units, 20 per unit. Additional cash fixed cost 30 million. These are all the expenses when you want to start a project. But what is important is this one: the project's share of allocated fixed cost will be 3 million per annum based on the principle of ability to share. This means the entity is going to have branch across the world, and whatever the company's central cost, common cost, will be shared among all the subsidiaries, let's say. So whether this company is started or not started, the expense at a total level will not change. At an entity level can change. If it is 1 lakh, either you divide by 5 or you divide by 4. But total 1 lakh remains same. So while making decisions, these common costs are not considered. In costing also you would have relevant. You would have discussed relevant costing and all. If something is common between two decisions, then that expense or information is ignored. That's what we apply here as well. Production capacity is 5 million units. Expected life of the project is 5 years. No salvage value. This will be helpful for depreciation. Existing working capital requirement for the production was 15 million. So this project requires 50 million of working capital, but you don't have to invest full 50 million because already you are having 15 million from your existing exporting process. And if you start a unit, that existing exporting process will no longer be applicable. So you need to involve additional 35 million as investment initially. Export of the product will be coming year decreased to 1.5 million units in case the company does not open subsidiary in view of the competition from MNC in the process of setting up their subsidiary in India. So we are going to analyze this problem on two decision basis. You start a unit or you continue to export. Don't come to India. If you continue to export, then your sale units will be 1.5 million units. That is our second column. And if you come to India, the information what you have been reading, sales minus expenses, minus depreciation, minus whatever tax, you get profit after tax, then you add back depreciation, you get cash flow after tax. So this is, you are going to start a unit, and if you don't start a unit, you are going to have 1.5 million units as sales. Applicable tax rate 35, a required rate of return 12. Assume there will be no variation in the exchange rate for two currencies and all profits will be repatriated with no withholding tax. Estimate NPV of the proposed project in India. So I just told you, whenever you see a big problem like this, we have applied this concept in bond valuation as well. Divide the information into three types of cash flows. Initial cash flow, what happens when the project is just started. Interim cash flow when the project is running, and terminal cash flow after the useful life is completed. So initial cash flow, alternative 1, you have to invest 500, working capital of 50, and if you continue to export, no investment here, but working capital, your existing 15 would continue. So on an incremental basis, if I analyze what would happen, initial cost 500 million, working capital 50, but from my existing things only gets released 15. So my incremental is only 35. And 500 I have to invest in my plant and machinery. So this 535 is my initial cash flow, initial investment. Then every year I'm going to have sales, I'm going to have variable cost, I'm going to have fixed cost, and therefore 5 million units is the number of units. Variable selling price 80. Here also selling price 80, variable cost 20, so 80 minus 20, that will be the, let's say, contribution, multiplied by 5 million, that will be the contribution total. Subtract fixed cost, do not subtract this 3, this is common cost, and depreciation also will subtract 500 minus salvage value 0 divided by useful life. If you continue to export, second alternative, then 1.5 million units only, and variable cost in that case would be 40, so please check it out. If you continue to export, presently the company is exporting and its variable cost is 40, and if you come to India, it's only 20. Yes, India, cheap labor, many things are cheap, so cost also coming down. So how do you going to calculate your sales 5 million into 80, 5 million into 20, so you can say contribution is 300, or you can say like 80 minus 20 60, 60 into 5 is 300. That is also fine. Subtract fixed cost, don't subtract common cost, then subtract depreciation as we calculated here, 500 minus 0 by 5, straight line method, you get EBIT, even depreciation you should subtract, tax rate 35%, you get profit after tax, add back depreciation, what you get is ultimately cash flow after tax. And this is the cash flow when you start a unit in India. I need only additional cash flow that is relevant for my decision making. So what is going to be my cash flow if you continue to export? Your sale volume is 1.5 million units, selling price 80 only, 80 into 1.5, 120. Variable cost in that case is 40, 40 into 1.5, 60. So profit before tax, no information on like depreciation and all, or fixed cost. So 60 minus tax rate, that 35%, you get profit after tax, no depreciation, otherwise I would have added. So by starting a project, my cash flow is 210.5. If I don't start, if I continue to export, my cash flow is 39. So my incremental cash flow is 171.5, and this comes every year, and the project is for 5 years, so I multiplied by annuity factor, and this will give me the present value of inflows. This is anyway is outflow, and today value, no need to apply any discounting factor. And last year the working capital gets released, 35 what you invested, this 35 what you invested gets released, and this 500 plant and machinery investing, but salvage value is 0, therefore not considering. But if salvage value was there, that also would have considered and added, and this would have given me present value of inflows of 618 here and 19 here, and subtract 535, investment will give NPV. NPV is positive, so proposal should be accepted. So this is a problem where foreign company coming into India. See if you have any doubts, or else we'll go to other situation, Indian company going to foreign. First table is only for information. Calculation is this one. This 15 working capital, because this is the working capital used at present. Now once you start a unit in India, the existing production facilities and all, you are not going to make use of it. So to that extent, that amount will be free now. So what you need to do is only the incremental thing. This is like you're having a bank account, you close one bank account and you open a new bank account. In new bank account minimum is 10,000, and in the existing bank account minimum is 4,000. So incremental 6,000 only I need to deposit additionally. So the same incremental working capital comes at the beginning, and same working capital comes at the end as a recovery of working capital, release of working capital, recovery of working capital. It will be initial also, in terminal also. The only difference indirectly is loss of time value of money there. Okay, let's read the next one. Indian company in the foreign company. So before we read, let me give you that one important concept there. there are two types of methods in which you can compute NPV if Indian company goes to foreign. Let me look at the charts and explain to you. Yes, so there are two choices are there. One, cash flow, you convert every year cash flow into rupee terms. The second choice what you have is keep the cash flow in foreign currency, you come to the present value and then you apply the conversion rate. Second one I'll explain easily. Use foreign currency cash flow. So if you go to US and start your unit over there, your inflation, your expenses, income, everything will be in foreign currency, US dollars. So result NPV when you calculate also will be in foreign currency. Once you get foreign currency, you multiply it by the spot rate and that is what you get NPV in rupee terms. Seems very easy, but there is one difference with respect to this discount rate. Why this will have an impact? Back to basics example again. In India, if you are expecting, let's say FD rate is around 6%, and from your business, obviously you don't expect 6% because your business is having more risk. Let's say you're expecting around 9%. So what is this 3% is called as? The extra return over and above risk-free return due to taking risk is called as risk premium, in simple words. In US also, if you see FD rate, it will not be 6%. Let's say FD rate is only 2%. Now, Indian person going to US, can I use 9% as the discounting rate? It is not, because 9% is the rate applicable in Indian currency rupee terms. When you go to US, you have to take the rate as applicable there. Therefore, the same premium, if I apply here 2% plus 3, it becomes 5%. So my discounting rate in US cash flow should be 5%. It's called as exchange risk adjusted discounting rate. Discounting rate adjusted for exchange risk. The basic concept is this: you take the risk premium and apply it on risk free rate. But we don't apply like this because this would be a additive model. Approximate answer is fine, but not accurately. So multiplicative model means we apply this 1 plus rate in foreign, 1 plus required rate of return. Required rate of return means the 9% in my example, divide by 1 plus inflation or interest rate in local. And don't worry too much about remembering the formula. It's the same formula, just the reciprocal of IRPT. So in IRPT, what we have done, 1 plus local by 1 plus foreign, and here I am going to do 1 plus local, 1 plus foreign by 1 plus local. Just inverse the formula. You need not by heart this. Then minus 1, just to get the 1 rupee out and get the actual interest rate. So if you are calculating the cash flow in foreign currency, we have to use this formula. That is converting from Indian expectation into foreign expectation. Why? Because all my cash flow is in foreign currency. Then my NPV also in foreign currency. My discounting rate also will be related to foreign currency. Only one step, last step, NPV multiplied by the spot rate. You get the rupee NPV. You make a decision. The other choice what you have is every year whatever cash flow you have in foreign currency dollars, every year you convert into rupee terms. But every year where do you get the forward rate? We get spot rate. Year 1, year 2, year 3, where do we get the forward rate? We expect that rate using IRPT. So from spot rate into 1 plus local by 1 plus foreign, I get year 1 expected forward rate. Into 1 plus local by 1 plus foreign, I get year 2 forward rate, and so on. So every year cash flow in foreign currency, convert that respective forward rate, I get every year rupee terms, and NPV also, therefore I get it in rupee terms. Ultimately both should match. It may not match because of rounding off, discounting rate would be a lot of decimals, but otherwise conceptually those two should match. I would recommend go with the first method because there will be a lot of inflation changes might be there in year 1, year 2, year 3. But anyway, any method you follow, you should get the same answer. Any conceptual doubt before I take a problem on this? Okay, so let's take a problem 2. XYZ company based in India manufactures very high quality modern furniture and sells to a small number of retail outlets in India and Nepal. It is facing tough competition. Recent studies in marketability products have clearly indicated the customer is now more interested in variety and choice rather than exclusivity and exceptional quality, since the cost of equity quality would be in India is very high. The company is reviewing the proposal for import of goods from Nepali supplier. Okay, don't worry about all these things. What is relevant for us is this: estimate of Indian rupees and the Nepalese currency cash flows for this proposal is given below. So if you start this project, these are all the cash flows in NC, Nepalese currency, and these are all the cash flows that in Indian rupees. The following information is relevant. XYZ Limited evaluates all the investments by using discount rate of 9%. This is the rate of interest or rate of discounting for whom? It is for XYZ Limited, Indian company. So when they go to Nepal, they can't use the same 9%. They have to adjust, or they have to convert the Nepalese currencies into Indian currency by applying every year forward rate, which is in turn calculated using IRPT. All Nepalese customers are invoiced in NC. NC cash flows are converted into rupees at the forward rate and discounted at the Indian rate. You don't have a choice here. Which method to apply? They only have given. These are converted into Indian rupees at the forward rate using IRPT and then discounted using Indian rate, meaning 9%. Inflation in Nepal and India are 9 and 8% respectively. The currency is 1 rupees, 1.6. Assuming you are a financial manager, you calculate the NPV and modified internal rate of return, MIRR. This was there in your previous life, IPCC. And the best part is in IPCC also you would have not done this. At least most people, MIRR, now they're asking in exam. You may use the following table. You may use means you should use, otherwise your may become November. You may use the following table with respect to discounting factor for 1 at 9%, present value, future value. Okay, NPV we have to calculate. So NPV, as I told you, first thing we need to convert every year cash flows into Indian rupees. We need a conversion rate. And what is the formula what we are going to use? IRPT formula. Spot rate is forward rate is spot multiplied by 1 plus local in this case is rupees, and divided by 1 plus foreign currency in this case is Nepalese currency. But look at the rate given, it is 1 rupee equals to 1.6. So actually the formula will now be inverted. Or what do you do, if you are not very clear when to apply which one, simply follow LHS RHS approach. In the sense, 1 rupee equals 1.6 Nepalese currency. So what do you do? What is the rate of inflation in India? India inflation is 8%. So for rupee, you are going to do 1 plus 0.08. Correspondingly, you multiply 1 plus R. For now Nepalese currency, it is 9%. So here you multiply it by 1 plus 0.09. And then you take this to right side. So 1.09 by 1.08. That's what they have done. 1.09 by 1.08. You get 1.615. That you take it. Then you multiply same thing. 1.09 by 1.08. 1.645, 1.630 you get 1.09 by 1.08. These are the forward rate applicable for 3 years. Then we will have the cash flows, Indian cash flows. It is already in cash flow rupees, nothing to convert. But Nepalese currency we are going to convert. Again, please be careful, multiply or divide. This is 1 rupee equals to Nepalese currency, and here what we have is Nepalese currency, which is right hand side. Therefore, we should divide. So the cash flow what they have given, Nepal currency divided by these exchange rates, 1.615, 1.630, 1.645. This will give me the rupee cash flows. Cash flow in India they've already given, and this we calculated now. Add both. You can do it in one table also. You get the total cash flow in rupee terms. Apply discounting rate in India 9% because they said at the beginning discounting rate is in India is 9%. So that discounting rate you use, you get NPV 19.53. So that 19.53, what you got, sorry, NPV you got minus 0.457. Negative NPV means we say that project is not to be accepted. Regarding MIRR, let me explain the logic. Again, it's previous live, but it was asked, so let me show somewhere. Okay. So what you are going to do like this, MIRR means year. For example, we have 1, 2, 3. I think in this problem 3 years are there. Then we have what we are going to do, cash flow in rupee only you have. That cash flow I'll make use of it. I'm going to calculate future value. Means year 1 cash flow, if I have to calculate future value, then I'm going to do 1 plus R to the power of 2. From year 1 end, I'm going till maturity, year 3 end. And this cash flow I'll multiply it by 1 plus R to the power of 1. From year end to year 3 end means that is 1 year. From year 3 to year 3 end, and this will be 1 plus R to the power of 0. So I get 3 maturity values. Basically means the cash flows are reinvested at 9%. The future value I get cumulative, and my present value already know, year 0 amounts. Present value, this is my future value. The life is 3 years, and we have to calculate the rate of interest. So that's what is all about the MIRR, modified internal rate of return. So what is this cash flow? We have got year 1 cash flow is total 4.479. Now this you can do maturity, or what they did is they have doing it on a reinvested basis. Future value is what they've applied. See, 4.479 I'll be reinvesting at the end of year 1 till the end of year 2. So I'm going to compound it for 2 years. So they have given the compounding factor as well for your help. So year 2, you see compounding factor is 1. I mean, actually it's reverse, no? Okay. This is year 1, this is year 2, and this is for year 3. Because you see the compounding value should increase. So from year 1 to year 3 means it is, or if don't worry about their calculation, you just do 4.479 multiplied by 1.09 square. From year 1 to year 3. 6.53 you multiplied by 1.09 to the power of 1 from year 2 to year 3. Then 7.09 is 1.09 to the power of 0 because year 3 to year 3 only. So cumulative 19.53, this is the future value, and 15.625 is the present value, and use the compound interest formula. F equals P into 1 plus R to the power of N. The future value is 19.53. The present value is 15.625. Number of year is 3 years. Then you have to calculate this. So how do you calculate this? Cube root of 3. Again in the calculator, there is a method, but I don't know, if it was 4 it would have been comfortable. You have to press the square root 15 times, minus 1 into 1 by 3 plus 1 into equal to 15 times. Anyway, I'll just explain to you that one. If you don't know, you can just quickly write down for your reference. So when you want to calculate this to the cube roots, so what we do is this: in calculator we press the square roots, and of course after typing that number, press the square root 15 times. Some people do it with 12 times as well. Then you do minus 1, then you do into 1 by 3. 1 by 3 because cube roots. Then we do plus 1. Then into equals to 15 times. This is unfair in the exam for you to expect to know this, but it was exam question. So square root 15 times, then minus 1 into 1 by 3 plus 1 into equals to 15 times, and that's how you get the cube root value. I hope they don't ask that cube root value in examination question. Again, don't just press equal to, into equals, that should be repeated 15 times. I hope you get that number, 1.0772, then you do minus 1, on simplification you get 7.72%. So MIRR basically means the cash flows are reinvested at the cost of capital till maturity. So you compute the future value first. Then you compute regular compound interest formula and calculate the rate of interest. Don't worry about this formula. Just use the regular compound interest formula. F equals P into 1 plus R to the power of N. F is this. Present value is today value. Number of year is 3 years. Rate of interest is what you need to simplify. Just basic compound interest formula only. They have calculated it. Okay, see if you have any doubt, else I'll go to that one more variety which has been asked in the problems quite a few times regarding the surplus fund management. Okay, so let me go to the third question. Suppose you are a treasurer of XYZ PLC in UK. You and XYZ have two overseas subsidiaries, one based in Amsterdam and one in Switzerland. You're sitting in India, thinking about a company in UK, having a subsidiary in Amsterdam and Switzerland. This is called as world tour. Notional, that's all, virtual. The Dutch subsidiary has a surplus euro of 7,25,000. This is again a typical problem asked in exam. One will have a surplus amount. Where to invest? Which it does not need for next 3 months, but which will be needed at the end of that period, 91 days. So for 3 months, you can invest for a short-term gain. The subsidiary has a surplus of Swiss franc in the amount of 9,98,000. That gain will be needed in 91 day 91. XYZ PLC in UK has net balance of 75,000 that is not needed for the foreseeable future. So everybody has surplus. Given the rates below, what is the advantage of swapping euros and Swiss franc into sterling? Swapping Swiss franc and euros into sterling means you convert the euros and Swiss franc into pounds. Sterling means pounds. So you are having a surplus in Swiss franc, you are having a surplus in euro, and you are having a surplus in pounds. So the Swiss franc euro also you want to convert it to pounds. That is what they are asking. Spot rate euro given 91 days points are swap points are added because they are increasing to compute the forward rates. Spot rate pounds to CHF is for that Swiss franc, 91 days points. Please observe it is decreasing, so to compute the forward rates we will subtract. Interest rates are given 91 day interest rate percentage per annum, amount of currency slab, so depending on how much you invest, corresponding interest rate is applicable. Holland, why Holland is coming suddenly? Oh, Amsterdam, fine. Euro, it's Europe, that's all you need to apply. Where is, okay, Amsterdam means Holland for them, fine. Okay, so we have how much Swiss franc and how much this euros, okay, whatever it is, we are having euro amounts. The Dutch subsidiary, okay, Holland, Dutch subsidiary means Holland. Oh, that all we should know, is it? Anyway, the Dutch means Holland. 7,25,000 is in euros. Now that need to be converted into pounds. Do we have a direct conversion from euro to pounds? I think we have. This is euro to pounds. So 1 euro equal to so many pounds. See, they have given pounds here. So euro is left hand side. 1 euro equals so many pounds. So left hand side is what we have. So directly we can multiply. No need to do any division. So 7,25,000 multiplied by 7,25,000 multiplied by what is the spot rate? And you are selling. Selling will be at a lower rate, and lower rate is 0.6858. So 7,25,000 into 0.6858, what you get is pounds. Means I'm looking at a situation of converting it to pounds, the second alternative. And then I will also have euros. Euros is done. How much I have? Swiss franc. Swiss franc is 9,98,000. That also I'll convert to pounds. Do I have direct conversion rates from this to pounds? I have, right? From CHF to pounds also I have. But CHF in this case is right hand sides, which means I have to divide for me to convert it to pounds. This is Swiss francs, right hand side, divide Swiss franc to be converted, so Swiss franc to be sold, and sold will be at a lower rate, and lower rate, because we are dividing, it will be 1 by higher rate, and higher rate is 2.3326. So 998.77 divided by 2.3326. So this is what you will get it in pounds, and they have their own pounds as well, 75,000. So all of them put together, it comes to 1 million something. So they will deposit for a period of 3 months, 91 days. And 1 million means what rate of interest applicable in pounds. So pounds, if you cross 1 million, rate of interest applicable is 5.375%. So you can see they have applied 5.375% for 91 days. So this is, you are having a option of converting it into pounds and ultimately deposit everything in pounds. This is one choice. The other choice what you have is, you have euro, deposit in euro. After 91 days, then convert it into pounds. You have Swiss franc, deposit into Swiss franc. After 91 days, convert into pounds. You have pounds, deposit in pounds. After 3 months, it will be in pounds only, and overall answer will compare and which one is better. But before we go to that option, any doubts in applying these rates? Taking the spot rates, you are having left hand side, so we multiplied, we took the lower rate, but this CHF was right hand side, so we divided, and the selling will be at a lower rate, so we took 1 divided by higher rate. And applicable slab rate, interest rate 5.375 for 91 days we have applied. See if you have any doubts. Again, these kind of questions also they have been asking quite a few times. Okay, so any doubts on this table? Okay. The first alternative what we are supposed to discuss is, we are going to deposit in local currency but converting it using the later point in time into our pounds. So we need a forward rate. So take a look at this first one, 7,25,000, and for 7,25,000 the applicable rate for this euro 7,25,000 is between 5 lakh to 10 lakh. The rate of interest applicable is 2%. So on 12,25,000, 2%, 91 by 360. This is the amount that will be matured after 91 days at the end of 3 months. Now this I need to convert it into my head office currency, which is pounds, using not the spot rate, using the forward rate. So forward rate means I'm going to add this number 6858. I'll add it to this 6869. I'll add it to this. I'll get the forward rate, and I have euro. I have to convert to pounds. Euro need to be sold, and left hand side euro, so multiplied, and will be selling at a lower rate. Lower rate will be 6858 plus 0037. I think that will come to 6895. This is the pounds that you will receive at the end of 3 months. Similarly, CHF you have. Please observe CHF. The rates are decreasing, means you need to subtract. 2.3326 minus 0.0228 because it's decreasing in order swap points. And CHF, you are having 9 lakh 98, which slab it will come to 9 lakh 98 means slave slab only 5 to 10 lakh. So applicable rate is only 0.5% for a period of 91 days. So CHF into 0.005, that means 0.5%, point off by 100. This is the amount you get after 3 months. You have to convert it into pounds. So CHF is right hand side you divide, selling at a lower rate will be 1 divided by higher rate. So 2.3326 minus 0.0228, I think that will come to 2.3098. That they divide, this is the amount you get after 3 months in CHF, in pounds. And your own pounds, 75,000 means you will be in the first slab. So for pounds, I think you get only 1%. Yes, 1% only. And this is also in the pounds after 3 months. And adding all 10 lakh 10 and here 10 lakh 10. Okay, 255. I think more or less same. Here 1 million 10. Here 1 million 13. Sorry, 1 million 13 you get. So you get little bit extra here. 1 million 13. So you have a gain in swapping from the currency into sterling. You have an advantage mainly because when you have everything in pounds, you go to the last slab where you get a higher rate of interest. That was the main reason. But anyway, you got a gain. That's what you need to understand. Compare the solution. See if you have any doubts. That is what with respect to International Financial Management chapter. So anything else in the international financial management? Next we have is interest rate management. Interest rate management I'll take slightly later. Maybe I'll take up some more topics which are coming later, like mutual funds we have not done. I will do that. Maybe valuation we have not done. I will do that. Then we'll come to the interest rate management. Okay, first of all, see if you have any doubts in this problem in calculation. A typical problem being asked in examination. Sometimes they may have apply cross rates also in this case. They may not give you the rates directly. Okay, so I'll go to the mutual funds. Okay, so the mutual funds typical problem what they ask is on computation of NAV. Sometimes reverse NAV, sometimes straightforward NAV. Net asset value means asset market value of all assets minus liabilities divided by number of units. Let's understand with the help of this good problem. RTP May 21 problem. Mutual funds problem number 1. The following particulars relates to S fund schemes: investment in shares at cost, pharmaceutical companies, construction companies, service sector companies, IT companies, real estate companies, investment in bonds, fixed income, listed bonds, 8,000, 14% bonds of 15,000 each. Number of units outstanding crores, excess payable, cash and cash equivalents, market expectation on listed bonds. The fund has incurred the following expenses: consultancy, management fees, office expense, advertisement expense, particularly relating to each sector as given, index on the purchase date, index on the valuation date. Calculate NAV of the fund, calculate the NAV per unit, determine the net return if the period of consideration is 4 years and the fund has distributed 2 per unit as per year in cash dividend during the same period. calculate the figure in rupees up to 3 decimals. Okay, so NAV of the fund, market value of asset minus liabilities. How do you calculate the market value? You have invested at the cost of 158, and when you invested it was 300, now it becomes 500. So when it was 300, you have invested 158, and when it 300 became 500, what will be this proportionate value? We assume that the value is moving in tandem with index, so it is going to be 150 into 500 divided by 300. So like that we are going to calculate for each of these things. 158 into 500 by 300, I think you get 263. Like that you did for all other things. 62 multiplied by 490 by 275, 112 into 500 by 285, 68 into 515 by 270, 20 into 440 by 265. That's how I got the each and every individual market value of investments. Listed bonds is actually slightly controversial. See, they have given 8,000, 14% bonds of 15,000 each. So 8,000 into 15,000, will you get 24? You get, I think, 20 or 120, I don't know. 8,000 into, you get 120. 12 crores, but they have put 24 crores, so means they have invested more. Anyway, it does not matter, you paid more. But what is important is this. Okay, so before we take a look at this, let me ask you, there's one formula called as perpetuity or perpetual cash flow. The formula is given by cash flow divided by rate of interest. Basic one only, means if you get 10,000 rupee cash flow and rate of interest is 8%, what is the value of it? See, for example, if I give you every year you get FD interest of 10,000 and rate of interest is 8%. How much should be the amount of deposit? Income divided by the percentage. That's what is value of perpetuity, and that's what we calculate also. I don't know, somehow some people don't understand this, though it's a very simple one. I'll try to explain. If you have 1 lakh, if you get 5% interest, then you know 5,000 is the interest income. If I give you 5,000 interest income, rate of interest is 5%, what will be the value of deposit? How do we calculate? 5,000 divided by 5%. We just divide by the percentage to compute the value, and that's what they call it as perpetual cash flow as well. Now here my income is 14%. Now 14% is applicable on which number? 14% usually we apply it on face value. So we should apply 14% on 15,000. This is the amount of income into 8,000. How much you get? On 15,000 into 14% into 8,000. This is the income, present income. So what do you get? 168, 1 crore 68. So 168 lakh is what you get here. This is rupees in lakhs? No, or 1.68 you get. Crores. Okay, so you get 1.68 crores or 168 lakhs. Then what do you do? My expectation in the future year is 8.84%. So this I'm going to divide by 8.842%. This was supposed to happen. To know the value, this is like this. Whatever is your income divided by future required rate. Your income is what you just calculated now. The coupon income is 168 lakh and my expected rate of return is 8.842 lakhs, 8.812 percentage. This was supposed to be the calculation, but somehow institute applied this 14% not on face value, they have applied it on cost. That is their interpretation. Basic formula is this. If you want to understand, whatever is your cost of investments, you multiply it by the present yield divided by expected yield. But this yield, if it is given in coupon percentage, I don't take cost of investment, I will take the face value of investment. That is, it will be face value of investment multiplied by coupon rate and divided by expected yield. Anyway, this is what ultimately happens. In the numerator, it will give you present income from your investments. The face value of investment into coupon rate is the income, or cost of investment into present yield is your present income which you're generating. So numerator is income, denominator is expected yield, and that's how you get the value of investment. Unlisted bond is at cost, cash and cash equivalent, they have given 3 as it is. Then expenses payable, in the information they said consultancy management, office expenses, advertisement expenses. So if you add all, how much you get? 7 crores. How come 7? Okay, this expense payable 7 crores. Yeah, they have given. This is already incurred, meaning this is expense incurred, but that will go to P&L account. What we need is ultimately in the balance sheet liability side, expense payable is 7. So you take asset is 788 minus 7, 781, divided by number of units, and that's how you get NAV per unit. Okay, second part of the question. Okay, before third part of it, first you look at this table calculation, see if you have any doubts. Which calculation is confusing? They are valuing the bonds, and valuation, how we are doing? Income by required rate of return. Numerator is income, denominator is my expected yield. When the yield changes, the value will increase. So if my FD income is 1 lakh, market rate is 8%, so value of that is 1 lakh by 8%. If the rate of interest changes to 8.25 because of, let's say, RBI decision, then 1 lakh divided by 8.25%. So my value of the bond will change. Listed bond calculation is confusing because it's not part of mutual fund, it's part of listed bond, it's part of bond valuation. Okay, let's see if I can help you calculate the bond valuation. Going back to the basics, bond valuation. Okay, what is the basic formulation or value of bond? What we calculated earlier. The present value of bond or intrinsic value of bond is, we take income, the coupon, divided by 1 plus rate of interest. Second year coupon divided by 1 plus rate of interest to the power of n, and so on. Last year redemption value divided by 1 plus r to the power of n. This is the present value of bond. Now you imagine there's something called as perpetual bond. Means how do you calculate the value of perpetuity? This will be coupon divided by 1 plus r, coupon divided by 1 plus r plus dot 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 forever, because it is perpetual, infinity. The simplified formula for that is given by coupon divided by 1 plus coupon divided by rate of interest. This is the simple formula for perpetual bonds. How do you calculate coupon? The face value multiplied by coupon rates, and that's how you will get the coupon per share or per bond basis. And what is this R? R is about the expected yield. So the formula for value of listed bond, if you want to write down the value of listed bond, is given by numerator coupon. And how do you calculate coupon? The face value multiplied by the coupon rate and divided by R. R means the required rate of return. Required rate of return. Okay, now imagine this value of the bond happened to be, let's say coupon is 8%, face value is 1000, so coupon is 80, and divided by required rate of return was, let's say, 12%. So how much you get? Let's take it as 10%. So it is 800. 800. Now what is this 10% is called as? It is called as the required rate of return, expected yield. Now imagine 1 year over. 1 year over. What will be my cost of investment? At what rate I would have purchased? I would have purchased at 1000 or I would have purchased at 800. At the time of purchasing, the required rate, the coupon rate was 8%. At the time of purchasing, the required rate was 10%. So at what rate I would have purchased? I would have purchased at 800 1 year back. I would have purchased at 800. And what was my expected rate at the time of purchase? 10%. At the time of purchase. I'll just call it as yield or something. Now 1 year later, the situation have changed. The yield or expected yield has become, let's say, 11%. Now how are you going to value as on this date? If I take the coupon rate of 8%, I will apply it on face value. My income is 80 rupees. Or if I am calculating on my cost, what rate should I apply? Not the coupon rates. I should apply the yield at the time of investment. The yield was 10%. 10% on 800, I'll get the same number, 80. And divided by my expected rate of return, which is 11%. Okay, so now you see the problem. See if you are able to follow it. What they've given in the problem: listed bonds 24 and your yield is 14%. That is the institute interpretation. I don't agree, because according to me this should be a coupon rate, but anyway, for the time being you treat like a yield at the time of investment. Then how do you do? 24 is the cost of investment multiplied by yield. Cost of investment into yield will give you coupon, and divided by the expectation of listed bonds yields, that is 8.842%. So 24 into 14%, this is the cost of investment into yield at the time of acquisition, divided by 8.84%, that is the yield at present. That is going to give you the value. According to me, what should be the calculation? Not on 24. According to me, it should be on the face value. 8,000 into 15,000 into 14%, treating this 14% as a coupon rate. They have treated this as a yield at the time of acquisition, and therefore they have calculated on 24, 14% divided by this, and that's why I gave you this one. Cost of investment, you take the present yield. Present yield means at the time of investment, divided by expected yields. Whereas on face value, I take the coupon rate. Ultimately in the numerator, what I get is coupon. Denominator is required rate of return. And see if you are able to follow this point. Hope it is fine. So do not worry about these information, consultancy fees, office expenses, advertising expenses, because this is expenses incurred. And what we are going to apply is on the cash balance. And cash balance is as on date. Sometimes in the problem they'll tell you, they'll give you this cash balance at the beginning. And then they say expense paid like this. So beginning opening cash balance, subtract all the expenses, then I get the closing cash balance. But here that's not the case. The cash balance is already given as on the date, and therefore these expenses would have been already subtracted. Do not consider again. Okay, then what the determine the NAV if the period consideration 4 years and the fund distributed 2 per unit during the year as cash dividend during the same periods. Okay, so what is your investment then, assuming the cost of investment was NAV 4 year back? Add all these numbers, assume nothing was there, only this cost of investments, 158 plus 62 plus 112 plus 68 plus 20, 420, assuming that only this was there at the time of investment. Again, assumption, or you can also say this also was there at the time of investment. So if you consider these cost was there at the time of investments, that means you get 420 divided by number of bonds also they have taken, no? Goods. Okay, they have taken 38, 24 plus 14, bonds also taken, good. So the cost of investment, whatever invested 458, that would be the value 4 years back divided by 8.4 crore. This is the NAV per unit 4 years back, 54.5. So, and what is the NAV? We got it now. This is 93. So you know the formula, like NAV 1 minus NAV 0, like P1 minus P0 divided by NAV 0 plus any capital gain also we will consider, plus capital gain into 100. So NAV at the year end, it was 93. Beginning NAV, as we just calculated here, 54.52 divided by 54.52 plus dividends. Dividend is they paid, I think, 2 rupee per year or 4 rupee per year. 2 rupee per year and for 4 years. So I can say plus 8 rupees during the holding periods into 100. You get 80 something. Okay, 85.25. This is for 4 year. This is called as holding period return. And for per year means you can divide by 4. That will give you per year return some 21 something. And that's what they have given. Okay, see if you have any other doubts in this mutual funds problem. Okay, so next problem regarding something called as dividend equalization. Okay, let me tell you what is that dividend equalization basically means, and then we look at the problem. You will have the existing some mutual fund or unit holders, then there will be some new people. For example, let's say on 1/4/21 there was some existing 10 lakh people, and during the year you made some profit, let's say 80 lakh, and on let's say 30th of September some of 1 lakh people joined newly fresh. So what they should do is they should pay the amount of the 80 lakhs, because they are going to get that money also when they get the dividend later. See, this is like very similar concept in debenture you had called as the ex interest cum interest concept. So when you purchase the debentures, you not only pay towards the cost of investments, but you also pay for the interest accrued till date. Similarly, when you sell the debentures, you're not only going to sell for the value of investment, you also recover the amount towards interest accrued till date. And that concept in mutual fund is called as dividend equalization. So when mutual fund issue units, they collect the money towards the mutual fund, they also collect the money towards the interest accrued till date. So when, if you can say like this, so what it's called as maybe like whatever amount collected by mutual funds will be whatever the NAV as on this date. NAV is towards the mutual funds, and they will collect also towards the dividend accrued till date, and they will also going to collect one more money that is called as the entry load, which is basically like a commission. Like when you purchase you pay brokerage commission, and when you sell you pay brokerage commission. So that both of them they will collect. So NAV they will collect, dividend accrued till date they collect, and entry load also they will collect it. That's like a commission on purchase, ultimately inflow for the mutual funds. When they sell, they are going to give you NAV, and they are going to give you dividend as well, because they are likely they should pay. That is a dividend accrued to you, you should get it. But load they don't add, they will subtract exit load. That is like selling commission. Therefore you must get 100 rupees NAV, you will get it. Dividend accrued, you are eligible, you will get it. But exit load is subtracted, because that is like an expense we are deducting. So when many people what they think is this entry and exit, everything is opposite. Yes, NAV here inflow and outflow, that is correct. Entry plus entry, exit load minus, but this dividend is added in both the cases. That is not plus minus, that is plus in both the cases, because while the mutual fund, while new people comes in, they bring in, and while they go out, they will get paid. In the sense that is an addition to NAV in both the cases. They bring more or they get more. But entry load, exit load, in both cases it is inflow for the mutual funds. So it is plus in one, minus in another. So keep this in mind, or you can say like this. They also asked in the question, right? You'll understand. I'll write there only. They said compute issue price. The issue price will be NAV plus whatever the dividend accrued plus entry load, or let's say front end load. And both are same, front end load or entry load. For repurchase price means redemption price. Redemption price will be NAV plus dividend accrued but minus back end load or exit load. So everywhere plus, only that commission load is what we get added and subtracted. That's all, you keep it in mind. Let's read this. On 1st of April 2000, okay, whatever, 1st of April, an open-ended scheme mutual fund had 400 lakhs outstanding with net assets value of 19 rupees. At the end of April, it issued 5 lakh units at an opening NAV of 2% load, adjusted for dividend equalization. At the end of May, 4 lakh units were repurchased, means redeemed, at the opening NAV less 2% exit load, adjusted for dividend equalization. At the end of June, 60% of its available for income was distributed. 60% available income was distributed. In respect of April to June quarter, the following additional information is available: portfolio appreciation, income of April, income of May, income of June. You are required to calculate how much income available for distribution, issue price, repurchase price, NAV as on 30th of June. Okay, so here how much income available? Let's start with income earned. Income from April month, you have earned income of 31.96. So you have earned 31.96, and number of units were 400. So 31.96 divided by 400 per unit was 0.0799. Then in that month of April, you have issued 5 lakh units. 5 lakh units you have issued means from these people you collected dividend or you collected income accrued till date. So 5 lakh units multiplied by 0.0799. So 405 into 0.0799, nothing but this is 31 plus 0.399, 32.3595, because you would have collected the money from these new entrants. Income on May you have earned income of 46.125. So 46.125 divided by 405.1139. So at the end of the month, 405 continues as it is. 32 plus 46, that becomes 78. So divide by 405 or 0.07 plus 0.11, 0.1938. Now at the end of May, 4 lakh units were redeemed, means they are repurchased or they are sold in a way. So when you sell, you are going to give them dividends, that is income accrued till date. So what was income accrued till date? Cumulatively 0.1938. So for those 4 lakh units, 0.1938 you are going to give it to them. So you distribute to them 0.7752. What remains with you is 401 lakh units, and the income is 77.0953. In the month of June, additionally you made 58.47, you made 58.47. So total income available for you now is 77 you had plus income earned 58. So total available is 136, 401 units, 136 by 401, that is 0.3396 per unit. And how much you distributed the dividend? 60% of the available income. So of this 136, whatever you have, multiplied by 60%. I think that is 81.7076, that is distributed. What is remaining at the end is 54.4717. This is the income which is remaining after distribution of 60% dividend. Then second part of the question, issue price. Issue price, start with opening NAV, add entry load of 2% on 19 they said, then minus then add dividend equalization 0.0799 we calculate here at the time of issue. What is collected? Dividend accrued. Whereas repurchase price, will take the opening NAV 19, exit load 2% subtracted. I told you exit load subtracted, and whatever NAV dividend at this point in time, at the time of distribution is 0.1938, and that number is added. Dividend equalization is always added to get the repurchase price, redemption price. Closing NAV, we start with opening NAV 19 into 400, that is the opening net assets. Whatever income we collected, I'm going to add, and whatever I'm distributing, I'm going to subtract. So how much we collected? 19.46 and multiplied by 5 lakh units. This much money received. 18.188138 multiplied by 4, I think. This much is distributed. This is paid out. So 19.46 into 5 is received. 18.1838 into 4 is paid out, subtracted. Income received, which is these three. 15.515, 31.96, 46, 58. This is the income receipts. 31.96, 46, 58, and you paid some distribution, dividend also you distributed. Okay, that would have been considered as net income there. So income received 31.96, 46, 58, fresh units received, then you have repurchased, then you have repaid dividend. How much dividend you repaid? 81.7076. That is outflow. So you subtract, you get closing NAV, divide by number of units, you get NAV per unit. So take a look at this one and see if you have any doubts. Opening NAV plus income plus whatever received minus whatever is paid. Okay, next one. Messrs Corpus AMC on 1/4/2015 has floated two schemes, dividend plan and bonus plan. Mr. X has invested in both the schemes. The following details except issue price are available: dividend percentage, bonus ratio, dividend plan, bonus plan. Additional details: investment, average profit, and average yield. You're required to calculate the issue price of both the schemes on 1/4/2015. I think this column issue is there. I think this 9,20,000 is for a dividend plan. Bonus plan investment is 10 lakh. You made an average profit of bonus plan, and they have given average yield for, I mean, the average profit for a dividend plan and average yield they have gone for bonus plan. So that is two different columns. Apply the alignment properly. Okay, so average profit you have 27,748. That is average profit, means profit per year. And how many years have completed? 1/4/2015 is the investment, 31/3/2020 is the ending. Therefore, the life or the holding period is 5 years. So 27,748 multiplied by 5. This is the total profit made, and for investment of 9,20,000. So what will be the total inflow or value of investment at the end? 9 lakh, I mean 27,748.6 into 5 plus 9,20,000, the profit plus cost. 10,58,000. I hope that is the number. 743. NAV also on this date is 49. So if you divide by NAV, you will get the number of units. NAV number of units on 31st of March. Now then you keep working backwards and you go till 1/4/2015 and you try to calculate what would be the NAV as on this date. You have to go backwards. And how do we go backwards as on this date? I think I should have a slightly better method of calculating it. Oh, this is okay. So I think let me show the calculation to you. Institute has done it, but let me show my methods as well. Okay. The format which I would recommend usually will be this. Just give me 1 second. Okay. So what format is this we follow, or I follow? Whatever the date on which the dividend is paid, and how many ever number of units you are having, or what you write is dividend received. And in the dividend reinvestment, what do we do is the amount of dividend we receive will be reinvested at the NAV prevailing on the date of reinvestment. So if I divide by NAV, then it will give me the additional number of units, and this will be added to my existing units, and thereby I get the closing units. Okay. Now in the given situation, what we know is closing number of units is 21,607. That means I know the last line here on 31st of March 2020. This is known to be, we have calculated 21,607. And what was the dividend date? Previous information dividend date we have is on 31st of March 2019. How many units we had previous to that? Or we can do like this. They have given 12%. Do we know the face value at least? If you don't know face value, then how do we calculate? Because the percentage should be applicable on face value only, no dividend percentage, 12%. Okay, I think that we have to assume, otherwise the problem will not go anywhere. So we have to assume face value is 10 rupees. Otherwise the percentage, we don't know on which amount to calculate. Percentage of dividend is always applicable on face value. So let's assume face value is 10 rupees. So this will be 1.2 per unit. This will be 10 per unit. This will be 1.5 or 15, now 1.5 per unit. This will be 1 per unit. This will be 1.5 per unit. Okay. Fine. So if you assume you had, let's say, existing number of units as some number x. If you have existing number of units as x, so how much dividend you will receive? On the last situation, you received dividend of, on 31st March 2019, you have received dividend of 1.5. So if you assume the previous existing number of units was x, this would be, can I say, it will be 1.5 into x, the existing number of units multiplied by dividend per unit. This is the amount received. So 1.5 into x is the amount received divided by NAV on this date. NAV on 31st March 19 is 45 for this plan, divided by 45. Okay, whatever the number you get here, can I say 1.5 by 45? So 0.0 something. 0.033, is it? 0.033 is X. Yes, this is the additional units. Plus existing we had X. So closing should come to 21,607. This is my closing units. So after investment, this should be this. This is 1.033 equals 21,607. So you calculate 21,607 divided by 1.033. How many units you get? 20,910. So this is the existing number of units, which you will get it in the previous step. 20,910. You have to keep doing the previous step and come to the beginning. Then we'll get the number of units at the beginning. You have to keep coming backwards. Just understand one line, then previous and all will be a similar process. Then again, if you repeat the process, what do you do? What is the previous per share? 1 rupee per share multiplied by X, and NAV on that date is 50. So 1 into X divided by 50 or 40 NAV on the previous date, or reduced. Okay, 50. This whatever number you get, I think 0.02 X plus X should be equal to this number, 20,910. So 20,910 divided by 1.02. 20,500. Similarly, what is the dividend prior to that? 1.2x plus on this date is 48. So it is going to be 1.2 into x divided by 48 plus x should be equal to 20,500 and equals. So what will be this? Is 1 point. This is equal to 0.025x plus x should be equal to 20,500. 20,500 divided by 1.025. I think 20,000. So number of units at the beginning is 20,000. Then amount of investment you made. You made a 9,20,000. 9,20,000 divided by 20,000, and that would be the beginning issue price. Just understand this one calculation, then you just keep going backwards. Or if you want to remember like a formula kind of thing, you can use this. Whatever the existing units multiplied by dividend per unit divided by NAV plus existing will be the new number of units. Existing number of units into dividend per unit by NAV plus existing is new number of units. So you keep going backwards. Existing you take it as X, dividend per unit they will give you plus existing, that is X were taken new. Okay, so this is regarding dividend plan. Now bonus plan is actually very easy. This will not be confusing because bonus is a ratio. So what is this number? 1:5 means if you have 5, you get 1. So post bonus you will have 6. So I can do 1 by 6. Or if you have after bonus 6, before bonus would be 5. So you can do into simply 5 by 6. And 1:4 means if you have 4, you get 1. So after bonus it will become 5. So before bonus it was 4. So you can simply do into 5 by 6 into 4 by 5. You get the answer much faster in case of bonus plan. Yeah, that's what they have done. 5 by 6, 4 by 5. So number of bonus, number of shares, same process. That is okay. Average dividend yield. How do you calculate here? On 10 lakh, you get 6.4%. So 10 lakh into 6.4% for 5 years. This 3 lakh something. 3,20,000. This is the profit plus 10 lakh. So investment should be 13,20,000 divided by 44. That will give you the number of units. $30,000. This is the closing units. So keep going backwards into 5 by 6 into 4 by 5. That will be the number of units at the beginning. 20,000. So 10 lakh is the amount of investment. 20,000. So 10 lakh by 20,000. That would be like 50 rupees something. So that's how this problem has been framed. Okay, so that's about mutual funds. See if you have any other doubts. Bonus plan, then dividend reinvestment plan. Okay, so that would be with respect to mutual funds. So any other doubts in the mutual funds section? So this is how actually whatever I have done the calculation. Okay, so let's take a break for lunch and then we'll have 3 chapters to cover. Interest rate management, mergers and corporate valuation. I think those are the 3 others. The theory chapters, as I told you, I have done a separate marathon. Please watch it at your time, convenient time later. That is a full day. So about 7 hours something, 6 hours, 7 hours. Only on theory, you read it separately. So we'll take a break. 1:50 now. Let's meet at 2:30 and we'll try to do it in the next session. So we can leave early means we can go home early. So 2:30 will meet. I know slightly shorter version, but we can finish it up fast. So 2:30 will meet, and then we'll go for next remaining chapters. 2:30 will meet. Done. Okay, so let us move to the next chapter, interest rate management. Let's understand with the help of this problem. eSpaces PLC is a consumer electronics dealer. The business of the firm is highly seasonal in nature. In 6 months of a year, the firm has huge cash deposits, and especially near Christmas time and other 6 months from cash crunch, leading to borrowing of money to cover up its exposures for running the business. It is expected that the firm shall borrow a sum of 25 million for the entire period of slack season in about 3 months. The banker of the firm has given the following quotations for forward rate agreement. Spots 3 by 6, 6 by 9. 3 months 50,000 euro future contract maturing in 3 months is quoted at 94.15. You are required to advise the position to be taken in future market by the firm to hedge the interest rate risk and demonstrate 3 months future contracts shall be useful for them if the interest rate turns out to be 4.5, 6.5. It's only future, but actually the question had the forwards also. I missed putting that thing, so we'll do both the forward and future. Evaluate the interest cost shall be less. Okay, again, okay here. Had it adopted the route of FRA instead of future contract, ignore the time value of money in settlement amount of future contract. So first thing is a forward rate agreement. As the name suggests, the forward rate agreement is the agreement in which the rate is committed. Just like the forward rate agreements in foreign exchange, where the forward rate is determined in advance. But the difference with respect to this chapter is you are committing for taking the loan after some periods. So in case of forward purchase, what happens, for example, for foreign exchange, after 3 months you are going to purchase. There ends the transaction. But here, after 3 months or 6 months, you are going to borrow the money and then you are going to repay the money. So you have to consider 3 points in time. One is today, date of signing the contract. Then second date, date on which loan is taken. and the third date on which the repayment is going to take place. So 3 dates you have to keep it in mind, especially in this case. So if you read once more in this problem, um, in 6 months the firm will have a deposits, in 6 months firm will have a cash crunch. Now the thing is, in which stage they are in now. The entire period of slack season in about 3 months, that is after 3 months you will witness 6 months shortage, or you need to borrow the money for 6 months, but you are not borrowing it today, you are going to borrow the money after 3 months. After borrowing for 3 months, you need the money for 6 months. Therefore, the money repayment will happen, if you count from today, at the end of 9th month. That is, this is what it looks like. Today, you are borrowing after 3 months and your repayment after 6 months. So actually, you are going to borrow for a period of 6 months. This is what it looks like. You're borrowing today, you're signing the contract today, you're borrowing after 3 months, and then repayment after 6 months. So from today, if I count, it is 9 months. So what quotation we are going to apply is this starting point is 3 and ending point is 9. So the quotation what we need to apply is 3 by 9. And the difference between these two represents the term of the loan. So in this example, if you see, 3 by 6 means the loan period is 3 months. 3 by 9 means the loan period is 6 months. And we require 3 by 9. That is, after 3 months I'm going to borrow, and 6 months after that I'm going to repay. In general, if you count from today, 3 months you are going to borrow, and from today, if you count, after 9 months is a repayment date. Essentially, loan period is difference. So the applicable forward rate is 3 cross or 3 by 9, representing 6 months term. 3 is the starting point, 9 is the ending point, counted from today. The rate of interest, since you are borrowing, you are going to borrow at a higher rate. Therefore, rate of interest applicable is 5.94%. So what is this 5.94%? Irrespective of what happens in the market, you are going to borrow the money at 5.94%. That is what the rate you are committing. The bank is giving you the commitment that you will borrow the money at 5.94%, and settlement can happen on net basis or settlement can happen on delivery basis. And when they give you these situations, 4.5, 6.5%, in those situations it will be settled on net basis. Otherwise those things were not required. So they have given for the main purpose that it is settlement on net basis. Okay. Now just imagine this. After 3 months, you have committed at 5.94%. Suppose rate of interest happened to be 6.5. You have saved interest. Because had you not entered into this agreement, you would have ended up paying 6.5. Therefore, you will receive as the compensation from the banker the difference. But when is this amount going to come to you? You will know at the end of 3 months, but money will not come to you at the end of 3 months. Money will come to you only at the end of 9th month, because the interest is applicable only at the time of repayment, not at the time of borrowing. So the interest what you calculate is actually to be settled on repayment date. But if you want to settle it on date of borrowing itself, then you are going to discount it. In other words, we are going to write a formula for it. Let's solve it. I think solution is not there in the material, so let's write it together for that. So let's say using forward agreement. So what format I'm going to follow is transaction today, and transaction after 3 months and transaction after 9 months, that is 6 months from that point onwards. Okay, so what you are doing today is you are just signing or entering into forward rate agreement at the rate of 5.94%. Okay. After 3 months, you're having two situations. Either interest rate is 4.5% or interest rate is 6.5%. Okay, so what we are going to do is this. The difference between the market rate and the forward rate either will come to you or will go out of you. Depends on whether it's plus or minus. Or formula as such, what we do is this. Like we do reference, I'll just write it here because I have space, but it will be settled on after 3 months only. So I'll do here, it is like RR minus FR. RR stands for reference rate, market rate, LIBOR, MIBOR, or any other bank rate. We call it as reference rate, the market rate basically, reference rate, minus FR, the forward rate which we have agreed, entered into, multiplied by whatever the principal. We call it as notional principal because sometimes the loan is not actually exchanged because we difference settle on net basis, multiplied by the principal, then multiplied by the term into T by 12, or if it is number of days, you divide by 365. Now when this amount actually will be settled, as I just told you, it will happen at the end during repayment after 9 months. But if I want to bring it to after 3 months only, then I should do a present value. So I'll divide by 1 plus R. And which rate of interest? I'd use the market rate. Market rate is reference rate into T by 12. So this is the settlement in forward rate agreement, net settlement. So FRA settlements. So I will use this formula for both the cases. So I'm writing it in between. So in the first case, I think it will be a negative number because reference rate means market rate 4.5. So 0.045 minus forward rate is 5.94% multiplied by principal. What is the amount of loan? 25 million. Into number of months is 6 months, 6 by 12, from 9th month to 3rd month. So this also will be 1 plus 0.0594, sorry, 4.5%, 0.045 into 6 by 12. The 25M means 25 million, 6 zeros are there. You get minus 1,76,39, something like that. 1,76,39 approximately. It is minus, so I'll just say it as outflow. And what is the logical meaning of this outflow? You would have been more benefited if you did not enter this contract because rate of interest reduced, but you end up paying more because you have already committed. Anyway, just look at the formula, RR minus FR. That much is sufficient for you to understand. Okay, this is in this situation. If it is 6.5%, then what would happen? 6.5% divided by 0.065. This would have been inflow. You would have saved interest cost. You get around, I think, 67,000 797 67,797, which is actually inflow because it's benefit. That is the second situation. Okay, but this will help you receive some money, but ultimately you need to borrow money because you require for business purpose. So you will borrow after 3 months. You are going to borrow, definitely. See, you borrow in both the cases. Ultimately, whatever may situation, you still borrow because you need for your business purpose. You borrow 25 million. At what rate of interest? You borrow at 4.5 from the market rate. And here what rate of interest we do? We will borrow at 6.5. I'm writing it one below so that I can show the corresponding impact. Okay, so after 9 months, what would be the situation? Again, two things I'll take: interest 4.5 or 6.5%. Okay, or I'll write next to that, that's also fine. Okay, so after 9 months, what would happen? This borrowing, whatever you are borrowing, on this you are going to repay interest. So what is the interest payable? On 25 million at the rate of 4.5% for a period of 6 months. You pay to the market. It is 5 lakh 62,500. Okay, 5 lakh 62,500. This outflow again because this is repayable. What would be interest payable in the other situation? Into 6.5%. That is also outflow. How much that will be? $8,12,500. Okay, now if I consider only interest, then the net calculations I can't make it. So what I'm going to do here, I should adjust the settlement in forward contract. So there are two methods possible. One method, this is the 5,62,500 I'm paying out as interest, and I'm paying 1,76,039. So my total will be this plus this is my net interest cost. But only one small point is that this is after 3 months, but this is after 9 months. So what I should do, this also have to bring it to 9 months by adding interest. Then I can do the net basis. But in some exam solution I've seen, they have not applied the time value. They have taken 1,76,000 and 5,62,000 net amount they have done it. Both way it's fine. But I would recommend to apply time value of money. So 1,76,000 after 9 months, include that number. That is applying time value. Indirectly means that is a loan I have to take and repay it along with interest. So 1,76,039 including time value, that is 1 plus 0.045 into 6 by 12 1,80,000 outflow. And therefore net interest cost $7,42,500. This is under this situation. What would be the situation into second one? It would be that 69,797 into 1 plus that rate you do into 1 plus 6.5%, same methods. One plus 0.065 into 6 by 12. $72,000. 70,000, right? 70,000, rounding it off. If I say rounding it off, 70,000, and 70,000 will be my inflow. 70 or 72,000. Okay. Okay. So what will be my net cost then? 8,12,500 is outflow. 72,000 is my inflow. And therefore net cost will be 7,42,500. You can see that whether market rate increases or decreases, I am able to achieve my fixed interest cost, and that is how I could hedge my position irrespective of the market. I am able to have my same amount. Of course, if I don't apply this time value of money, if I take this 1,76,000 and add this, if I take 69,797 and take this number, then I would not have got the exact same number, but approximately the number would be around that. So effectively, what is the rate of interest? Let's calculate effective rate of interest. So our effective rate of interest in both the cases is 7,42,500 on the amount of 25 million at the rate of, so expressed in percentage multiplied by 100, and this is for 6 months. How much for 12 months? So what is the number you have? 5.94%. That is what we have agreed earlier. Had we done a settlement on net base delivery basis, I would have just borrowed directly at 5.94 and I will pay 7,42,500. Only one line: borrow at 5.94, repay 7,42,500 if it's settlement on delivery basis. But when they give you these two rates, Under different situation, it's recommended you do it on net basis. So this is forward rate agreement, your net impact on borrowings. Uh, 67. What is the number you get? 67? 797, no? 67. Okay, okay, okay. Now you get the 72,000. That is a typing error there. 67 is what you should get. 67, 797. Okay, so this is using forward agreements. Now let us go for the next one, which is using the interest rate futures. We call it as IRF. Okay, so what the concept of IRF is all about? Okay, let me explain. IRF goes like this. It is a bond indirectly, but underlying instrument is interest rate future. When they don't give you the bond price buy and sell with respect to IRF, we calculate like this. The price is given by 100 minus rate of interest. So you buy at that rate in one day and you sell at another rate in another day. So suppose interest rate was 8%, then what would be your price? It would be 92. And if the next day when you exit, rate of interest let's say becomes 9%, then you will exit at 91. You see, rate of interest increased and therefore the bond price decreased. Now if you are worried about the borrower, we are going to take a short position on IRF. Short position means I sell it first and I buy it later. And what is the reason? I am worried about increase in the interest rates. Increase in the interest rate happens means what will happen to the bond price? Bond price will come down, and I want to make a profit in that situation. So if the price is coming down, I want to make a profit, means we are going to take a short positions on interest rate future. Or remember, borrowing for interest rate future, do not think too much. From exam point of view, if you're a borrower, you will short IRF. That much you remember. We'll apply it here in the given problem directly. So using IRF, interest rate futures. So I'll write just format like this: today, then later, or after, whatever the rate they have given. So you take a position on interest rate futures, and then you are going to borrow. Not today, but at the time of borrowing, basically. I mean, that's a money market maybe. As I just told you, interest rate future, you are going to short. Interest rate futures at the rate of, what is the rate prevailing on that day? Market rates. 3 months, okay, they have given 94.15. Sorry, I don't have to calculate. Short IRF at 94.15. They have given the problem. The interest rate future is trading at 94.15. You short at 94.15, and later you square off. Whatever you bought, you are going to do square off. And money market, you are going to borrow, and later you are going to repay, of course, along with interest. And now what we are worried about is what will be our net interest cost. That's what it's going to come in the last column. So short 94.15. This is one more interesting point. They have given lot size, I think. 3 months, 50,000 future contract. Lot size is 50,000. And look at the number of months, it is 3 months. But our borrowing period is 6 months. But we don't have that instrument. Instrument what we have is only 3 months. So how do I make 3 months into make it as 6 months? This is like this. We need 10 rupee packets chips, but they have only 5 rupee packet chips. You buy 2, you make it as 6. So 3 months contract, don't sign one contract, you make it as 2 contracts. So thereby you will be able to reach 6. So let's write that number of contracts. Normal formula what we do is number of contracts is equal to whatever the loan amounts or principal amounts divided by lot size. This would be our normal problem, normal regular calculation. But here, because the contract period is different, so what do we do is this. That is the whatever the borrowing periods divided by whatever the term of IRF. If both were equal, then it would not have made any difference. So principal amount is 25 million. Lot size is 50,000. Borrowing period is 6 months. And term of the loan is 3. Basically, we are doubling this. So what is the number of contracts coming to? Thousand contracts. 1,000 or 2,000? 1,000. Okay, 1,000. So you are going to enter into 1,000 contracts. And these 1,000 contracts are going to be squared off. And at what rate? The rate prevailing at that time, that is two situations they have given, interest rate 4.5 or interest rate 6.5. If it is 4.5, you will be squaring off at what rate? Squaring off at 100 minus 4.5. You will be squaring off at 95.5. If it is the interest is 6.5, you will be squaring off at 93.5, 94.5, 93.5. Okay, now short earlier means you sell, now square off means you will do buy. One sell, one buy. So it's going to be difference selling at 94.15, buying at 95.5. This is divided by 100 because this is actually percentage. The difference what you see is interest rate. So you should divide by 100. Multiplied by for term is 3 months. Why 3 months? Because the term of the instrument is 3 months. Your borrowing may be 6, but this interest rate future having a term of 3 months. So divide by 12 multiplied by the loan amount or the lot size. 1,000 contracts of 50,000 each. Just like the way we used to do earlier interest rate future. I think minus means outflow. $1 lakh. thousands, 50,000, 3 months, 1.35%. Oh, so 94.15. No, that is you get 1 lakh 68,750 outflow 1,68,750 outflow. Similarly, you calculate for the second one. Second one, I will not show the calculation. Hope you will be able to follow. It should be 94.15 minus 93.5 into 3 by 12 into 1000 contract, lot size 50,000, multiply. You will get inflow. Just see how much you get. Uh, 81,250 is inflow, so positive 81,250. Okay, money market you borrow and you repay. Interest we already know, so we can just repeat those numbers. Interest payable, we have already taken that number. So we know that we are going to borrow at whatever the market rates. Repay interest we already calculated. That number only we can make use of it. So what will be our net interest cost? 5,62,500 is outflow, 1,68,750 is outflow. So sum of those two. Seven lakh 31,250 is it? I think so. 7 lakh 31,250. In the first case and in the second case. So what will be the effective rate? Seven lakh 31,250 divided by 25 million multiplied by hundreds multiplied by 12 by 6. Actually, if you see what is that 5.85%, initially you entered at 94.15 and it told you 100 minus R will be this. So you do 100 minus 94.15, you will get that 5.85. Anyway, that may not happen every time because every time you may not do the 100 minus rate of interest. But whenever you do that, number will add up ultimately. So if you would recommend 5.85 here, 5.94, so in the futures may be more beneficial. Okay, so this is about because this loan, this interest at future will cover only 3 months interest, but we will make it into two. That's what. If you don't do this, I'll get 500 contracts. So by doing this, I'll make 1000 contracts. So I don't have to think that 1:2 and all. So if you use that formula, it will take care of those adjustments automatically. No, no. First 3 months only, I'm taking 2 3 months contracts. So if I just take one contract, it covers me 3 months interest. But in the 3 months, I'm increasing by one more contract. I'd make two contract for 3 months. Effectively, my 6 months interest is covered in the 3 months only. The amount of interest protected is for 6 months. Okay, so this is about the first problem we have. Second problem, interest rate swap. Okay, so let's read this. IB, an Indian firm, has the subsidiary in Japan, and Zaki, a Japanese firm, has subsidiary in India and face the following interest rate. Zaki Limited wishes to borrow rupee loan at floating rate, and IB wishes to borrow JPY at fixed rate. The amount of loan required by both the firms is same at the current exchange rate. A financial institution may arrange a swap and requires 25 basis points as commission. Gain, if any, is to be shared by the firms equally. You are required to find out whether a swap can be arranged, which may be beneficial to both the firms, what rate of interest of the firms end up paying. Again, let's not worry too much about the theoretical concept behind it. The process we can't really cover, but we'll understand the process to solve the problem. So what you do is you find out the difference. What is the difference in the interest rate? BPLR plus 0.5 and BPLR plus 2.5. So difference here is 2%, and 2 and 2.25, the difference is 0.25. So difference between the difference, that is, I can say 1.75. There 2% difference, and here 0.25%. So difference between the difference is 1.75. So basically this means the bank is charging 2.5% extra here, and the bank is charging 0.25% extra here. Extra they are charging because it is a risk premium, but they are not charging same premium. They are charging different premium, and that is the arbitrage we would like to make use of. Anyway, so steps is you find out the difference between the differences. Difference between fixed rate, difference between the floating rates, difference between the difference, and that is called as the swapping gain. Let's write that. Or have they done the solution? Or they have given some too many calculations. Okay, they have given. But anyway, let's write this way so that hopefully you'll understand better. So what you write is this: difference between difference. Swapping gain is difference in fixed rate minus difference in floating rate. It may be fixed floating, or it may be like JPY, INR, or USD pounds. It's the two types of loans. Difference in fixed, difference in floating. So difference in fixed rate is or floating, vice versa. For me, plus minus not required. Difference in the difference, or I'll write like this: difference in floating minus difference in fixed. That does not matter whether plus or minus. What I required is ultimately the difference. So floating rate difference is BPLR plus 2.5 minus BPLR plus 0.5. Basically 2% is the difference there. This is difference in floating, difference in fixeds, 2.25 minus 2. So ultimately you get 1.75. That's called a swapping gain. Actually this should be split. Okay, they have given, right? Split. Correct. Financial institution will arrange a swap. 25 basis points as commission. 25 basis points means 0.25. So for the dealer, he will get 0.25. And remaining parties, so other parties are the two companies, so they will get 50-50. So 1.75 subtract dealer's commission, remaining is 1.5 divided by 2, that is 0.75 each. Now this swapping gain is the benefit for all the parties in this ratio, but the parties will not receive this money, they will save interest because their objective is borrowing. So they don't receive money, but they end up saving their interest to this extent. That's how they achieve their gain. So gain is not cash inflow, gain is their savings in interest expense. How to structure this? Let's write the parties there. We have IB, then Zaki. So one you write IB, then you have like Zaki. In between them we are going to write it as who comes, that is dealer. Okay, now this basic format goes like this. Try to understand. You could have taken a loan, you go to bank and take a loan. That is one straightforward method. But here we are not doing that. What we are doing is we are making use of swap arrangements. What swap arrangement means, for example, if we take Zaki, they will go to bank and take loan. I mean, means they pay interest. And they come to dealer and they will do a swapping. So thereby they are able to achieve their target and they save the interest. Similarly, this IB person, what the company is, they will go to loan, they will go to bank and take one loan, and they don't do stop with that. They will come to dealer and they will swap their loan, exchange their loan. By exchanging it, they were going to save interest, and we have to structure that. Okay. Now, what is the loan in which IB is interested, or let's say Zaki is interested? Any case, it's fine. Let's say IB. IB wishes to borrow in JPY. And if you go to loan, what interest they get? If they go to directly the bank, IB go to JPY means IB JPY, they will be charged 2% interest. But they don't want to pay 2%, they want to reduce it. So what they do, they don't take a JPY loan, they take INR loan. And they come and exchange with the other dealer. Thereby you get the interest. We'll have to prove it. So what you are going to do is, IB is interested in borrowing JPY, but you do opposite. Therefore what IB does is, they go to the bank and interest, or with the bank they will go for INR loan. They want JPY, but they will go for opposite. So with the bank they do opposite. So similarly what Zaki should go then? They should go for JPY. And this is one simple structure. Please observe, whatever you are paying to bank, you are going to receive in the swap. If you are paying fixed, you receive fixed in the swap. If you are paying floating, you receive floating in the swap. You are paying JPY, you receive JPY in the swap. You are paying INR, you will receive INR in the swap. Swap means exchange, opposite. So you are paying INR, you receive INR here. So you receive INR, you pay INR. Ultimately, your objective is to reach JPY is reached. So before you go to the structure of interest rate, the first step you fix the type of loan. Now, Zaki, what you are going to do? You are paying JPY and therefore you will receive JPY and you are going to pay INR. So what effect? Net effect, JPY cancels, and net effect, what remains is only the INR loan. Okay, let's fix the interest rates now. You can write down this, then fix the interest rates. If you have any doubt until this stage, you can ask. The point to be noted is this. When you go to the bank, just write down this here, that is opposite of your intention or your requirement. Or can I say your requirement is actually achieved in the swap? Because if you go to the bank and take what do you want, well, the swap will be wasted. Swap will not be used. So opposite of your requirement, that's what you do, and that's what JP also do. Now, what is the rate of interest appropriate? Let's fill it up. What is the rate of interest that AB has to pay to the bank? That is committed. The AB has to pay INR means so IB has to pay INR. INR floating rate is BPLR plus 0.5. I'll just say like L plus 0.5 or B plus 0.5 something. So they have to pay BPLR plus 0.5. They have to pay. There is no agreement to that. They have to pay PPR plus 0.5. Similarly, Zaki has to pay JPY how much? To the bank. Zaki has to pay JPY 2.25. So that also you write 2.25. 2.25 goes out. Okay, now look at from, let's say, Zaki point of view. They are paying 2.25. So what do? You receive 2.25. So what will happen now at this point in time? Their position is now nullified, zero interest. Okay, so what is the rupee interest for Zaki? BPLR plus 2.5. Now if I pay BPLR plus 2.5 here, with agreement, without agreement, Zaki is paying ultimately same rate of interest, because 2.5 comes, 2.25 goes, effectively you pay BPLR plus 2.5 with circus also to BPLR plus 2.5, without the circus also same names, means why will they come to this? They should be given benefit. And what was their share? 0.75. So what you are going to calculate here is your normal loan, your regular interest minus the savings due to swap. Is BPLR plus 2.5 minus 0.75. So BPLR plus 1.75. Okay, now what you should do is, there are three parties. One party we have calculated. Similarly, we can calculate for one more party, and one person will be balancing figure. you should be verifying it. So either you can do for IB, dealer will be balancing figure, or you can fix for dealer and IB will be balancing figure. Both ways it's fine. So whom you want to fix it. One of them we can do it. IB similarly. Okay, fine. So what you do is you are paying BLR plus BPLR plus 0.5. So then what you should do? You receive. I'll write at the top somewhere here BPLR plus 0.5 you receive. So thereby your position is nullified. And what is your JPY outflow? For IB, JPY outflow is 2%. And if I write 2%, that means they don't get any benefit. They should be given the savings of 0.75. Therefore, it comes to 1.25. And the dealer you can verify. That is just for your verification. You can do it later. His position, ultimately, he should save 0.25. You can verify your position. And what is the requirement of the problem? What is the effective interest rate for IB? Effective interest is 1.25. Effective interest for Zaki is BPLR plus 1.75. That is the answer. You can verify dealer position. He would have got 0.25. Ultimately, you see, he received 2.25. He receives 1.25. He pays something. Effectively, I think 0.25 should come. That you can verify it later. That solves that problem. The key is identifying the swapping gain, and the key is making this chart clear. That is starting with the opposite intention or opposite of requirement. Once the starting point is clear, this process is done. Okay, so that's it with respect to this problem. This is interest rate swap. Okay, let's go further. Next problem in the interest rate cap. Interest rate cap is nothing but options on interest rate. You know, two types of option was there: call option, put option. Call option here is called as interest rate cap. Put option here it's called as the interest rate floors. Caps and floors. Call option, put option. XYZ borrows 15 million of 6 months LIBOR plus LIBOR for 10% for a period of 24 months. The company anticipates rise in LIBOR and hence it proposes to buy a cap option from its banker at the rate of 8%. Lump sum premium is 1% for the entire reset periods and the fixed rate of interest rate is 7% per annum. The actual position is as under reset period given. You are required to show how far interest risk is hedged through cap option. For the calculation, work out the figure at each stage at 4 decimal points. It should be part of working notes. Okay, so this formula they have given something different and all. Let me explain with the simple terms. So you have taken 6 months loan and the loan period is 24 months. What is 6 months and what is 24 months? 24 months is the loan contract, borrowing period. 6 months means 6 months once you pay interest. That's what it means. Every 6 months you pay interest. So how many times you pay interest then? 24 by 6. 4 times, 2 times a year. So 4 months, 24 months means 2 year. 2 times a year means totally 4. They have given 3. Maybe one more will happen 6 months later. They don't know that. But we will not know that number in advance. LIBOR is a market rate, and market rate increases means you end up paying more. So you want to protect yourself. So protecting means you went for cap option, means interest rate call. So what is the interest rate call basically does? It's exactly like call option, C for cap, C for call. So you can remember like that. When the call option is exercised, when the market price is high. Same situation here, when the interest rate is high, call option, cap option is exercised. So thereby what happens? I am paying interest to the bank, and because interest rate increases, I get intrinsic value from the cap option, and thereby I can reduce my interest cost. That is the meaning or the reason why we go for cap option. This LIBOR rates, you treat it like a market rates. This LIBOR rate you treat like a market rate. Before even going to market, in case of options, you have to pay premium. Now here, how many times you have to pay interest in a period of 24 months? You have to pay 4 times interest. So 4 times option contract is required. But you are paying one time only, one time lump sum premium. But actually it is related to 4 contract periods. So 1% on 15 million means 0.15 million. That is 1,50,000 rupees, I think. And that 1,50,000 rupees is not relevant for one cash flow. It is relevant for 4 settlements. I can't divide by 4 because of time value of money. Then what should I do? I should divide by annuity factor for 4 terms. You understand, right? If I have annual cash flow, if I want present value, what do I do? Cash flow multiplied by annuity factor, I get present value. Here I know the present value. I'm paying 1% for 4 years, for 4 terms, 2 years. So what I'm going to do, I will not multiply by annuity factor, I will divide by annuity factor. This formula is actually all about. This thing what they've given is effectively you're dividing by annuity factor. So 7% is the rate of interest annual. A half year means 3.5%. So 1 by 1.035 equals 4 times. You press GT, the annuity factor. So 1,50,000 divided by the GT annuity factor. That is what is your premium amount relevant for every term. You calculate that and see if you get approximately 40,600, 700. That's what these people also have done. The 4 decimal factors they have added. Present value factor, discounting factor they have added. Okay, so hope you got it. This is the premium that you are going to pay every 6 months once for the next contract. So nothing but this 1,50,000 divided by annuity factor. You are just converting into annual terms cash flow. Okay, so what will happen now? Let's discuss one by one. The strike rate is like a strike price. The strike rate is 8%. Market rate is 9%. Market rate is more, so call option exercised. Market price is more, call option exercised. Market price is more, call option exercised. And the difference between those two is what will be your intrinsic value, you can say. So let's see what they have done. Additional interest due to rise in the interest rate, amount received from the bank, premium paid to the bank, net amount received from the bank. Okay, so what is the additional interest due to rise in thing? Additional interest means you have this 8% is what your strike rate, but 9% is the market rate, so additional interest is 1%. So on 15 million, apply 1%, but this is said pay it 6 months once, so into 6 by 12, you get 75,000. This is the amount actually you are going to pay, or this is because of rising in interest rates, intrinsic value, market rate minus strike rate, and this is what you are actually going to receive from them. And you have already paid premium as well, 40,861. So net amount is what this will help you reduce your interest cost. Actually, these two columns are same only. Whatever additional interest you receive the money. So these two columns are not to be required. One column is sufficient. So whatever the amount received, so you can remember like this. This is intrinsic value, and this is the premium, and this is the payoff. That's the format, right? We used to discuss market price, intrinsic value, premium, payoff, and that's what they have done. Whatever the intrinsic value is this, premium is this, the difference between these two is the payoff. Means to this extent you are able to reduce your interest cost. Even though there is a rise in interest cost, to this extent you could reduce it. Okay, so that's all about interest rate caps. So borrower will go for interest rate cap. If you are an investor, depositor, you go for interest rate floor, but mostly we discuss only from borrower perspective. So from exam point of view, this is sufficient. Okay, so this is about interest rate management. Any other doubts, any other question in interest rate management? Okay, so let's go for the next one, valuation chapter. Valuation comprises of broadly, I would say, three areas. One area comprises of your dividend models. I'm not covering it. It's primarily part of IPCC, but at least you should know the Gordon model approach. The formula is P0 equals D1 by K minus G, and the problem may be asked even in multi-period dividend models. That is essential. Then we have some formulas on valuation using valuation multiple like P ratio, sales to price ratio. Then valuation using capitalization method like income by required rate of return, and valuation using like book value method and all, and FCFF valuation, free cash flow valuation method. That also we can look at a problem later. And then other small areas also problem may be asked, like economic value added calculation, right issue, bonus issue, promoters holding. This is one area many people somehow miss. You can see this is being asked in the last few attempts continuously, like in July 2021 buyback also asked, SGR calculation, that is sustainable growth rate, also being asked. Anyway, let's focus on some problems on dividends and some problem on valuation. Charts have been given, you can follow through that. Let's understand with the help of a problem. Sun Limited made a profit of 200 crore and paid out 80 crore, slightly higher than the average in the industry to which it belongs. Paid out means dividend. The average P ratio of the industry is 9. Average P ratio means if company earns 1 rupee, the value is 9 rupee for that. The estimated beta is 1.2 as per the balance sheet. Shareholders fund is 450 and number of shares is 10. In case the company is liquidated, building would fetch 200 crore more than book value and stock would realize 50 crore less. Other data for the industry is as follows: projected dividend growth rate, risk-free rate, market rate. Hope you imagine what this information would be for CAPM return. Calculate the valuation of Sun Limited using P ratio, dividend growth model, book value, net real value method. Using P ratio, what is your profit? Profit you make is 200, P ratio is 9, so the company is 9 times its profit, that is 1800. Using dividend growth model, the formula for dividend growth is P0 equals D0 into 1 plus G, or D1 divided by K minus G. For KE, you need CAPM. That's what they've used. RF 6%. RM minus RF 11 minus 6 into beta 12, 1.2. You get 12%. Once you get the cost of equity, substitute here. Value of the company or dividend just paid is 80 crores. So 80 crores into 1 plus growth rate. Growth rate is given as 4%. Projected dividend growth rate 4%. Divided by K minus G, 12 minus 4%. Using book value means book value, that is shareholders book value. They said the shareholders funds is worth 450 crores. If you go for net realizable value means if you sell the business, you get 200 crore more and 50 crore less. So plus 200 minus 50, that is your net realizable value or liquidation value of the business, net realizable value. So valuation using multiple methods. Next, B Limited has declared a dividend of 2 per share on the EPS of 7. Just declared means it becomes D0. Earnings of the company are expected to grow at 10%. So growth rate is 10% for the first 3 years and to be stabilized at 3% thereafter. So if you write it like this, year 1, it will be growth rate of 10%. Year 2, growth rate of 10%. Year 3, growth rate of 10%, and year 4 onwards, the growth rate is stabilized at 3% forever. The payout ratio is expected to remain same during first 3 years and then it will increase to 60%. It required rate of return is 16. Calculate the current price, expected price at the end of third year. Following table may be used. Okay. So what is the starting point of the dividends? The present dividend is 2.75, but 2.5 is E0. 2.5 increased by 10%. So 2.5 into 1.1, 2.75. 2.75 into 1.1, I think you get 3.025. 3.025 into 1.1, I think you get 3.327. This is D1, D2, D3 onwards, D3 up to DR3. These things I am going to do to present value. I have to multiply it by the respective discounting factor. But year 4 onwards is there, right? How many years I have to go? Year 4, year 5, forever. And this is where we take the help of Gordon growth model. I am going to write D4 by K minus G, because I am using D4 onwards. So I'll use D4. And when I use D4, the terminal value what I get is at the end of year 3. When I use 1 year forward, I get the opening value or the 1 year short. So when I use first year dividend, I get the price today. When I use a fourth year dividend, I get the third year terminal value. And this also have to multiply by third year discounting factor. This is what I'm going to call as intrinsic value or P0. And what this number actually means, this means the present value of year 4 onwards, year 4 to present value, year 5 to present value, year 6 to present value, and that is what is called as here terminal value 3, and this should be further be brought down into today value. Or tabular presentation, I always recommend like this, easy to write, year 1, 2, 3, year 4 onwards. Then cash flow, you write here D1, D2, D3, and here what do you write? D3 into 1 plus G or whatever, D4 divided by K minus G, and what you get is TV3. Apply discounting factor of year 1, year 2, year 3 and year 3. The last 3 will have same discounting factor, and this present value whatever you get, you call it as intrinsic value or value per share, or you can say P0. Only one small point is at the end of third year, they said the P ratio will the payout ratio will increase to 60%. So you have to calculate EPS also every year. Not for first 3 year, but I need it for 4th year onwards for that purpose. See, they have calculated EPS is 7 rupees, increased by 10%. 7.7. Increase it by 10%, 8.47. Increase it by 10%, 9.317. Increase it by 3%, you get 9.6. And why is this required? Because the payout ratio is calculated on 9.6. So 9.6 into 60% is what you are going to get it as D4. So they have calculated somewhere here 9.6 into 60%. Check it. Is it 5.76? 9.6 into 60%. 5.76. This is like D4 by K minus G. Cost of equity 16%, growth rate 3%. So 5.76 divided by 16% minus 3%. And this is what is the price after 3 years. And this, as I told you, this also you apply discounting factor, the D3, D2, D1, apply discounting factor, the present value, what we get is the market price per share, expected intrinsic value, theoretical price. That's what they have done, applied by discounting factor like this. Only point to be kept in mind, the last two cash flows will have identical discounting rate, because the third year dividend also a third year, this TV3 is also third year. Dividend and terminal value, last one will always converge. Keep that small point in mind. Okay, so any doubt on this multi-period dividend discounts model? Okay, next. This was in July 2021, reverse dividend calculation. Many people got heart attack, I think, by seeing this problem. Let's read. NM Limited is aspiring to enter into the capital market in 3 years' time. The board wants to attain the target price of 70 per share at the end of 3 years. The present value of its share is 52.03. Dividend is expected to grow at the rate of 15% for the next 3 years. NML uses dividend growth model for projection. Required rate is 15%. You are required to calculate the amount of dividend to be declared by the board in the base year so as to achieve the target price. In the previous problem, what we just did, we estimated the dividend, and based on that we calculated the present value as intrinsic value. In this problem, the present value is given and we have to calculate the dividends. In the sense, if I prepare in a tabular format like this, like if I write it here, 1, 2, 3 and 3 onwards. Dividends, cash flow, how I'm going to write it here? I don't know the dividend, so I'll write it like maybe X into 1 plus dividend is growing at 15%. So can I do directly 1.15x? 1 plus 0.15 into X. Base year is X. D0 is X. And at the end of the year 1.15, and second year it will be 1.15 square X, and third year 1.15 cube X. That is getting compounded. And last year is, that's what, okay, let me show that their solution only. See, D0 in, I have taken X, that told D0 into 1.15, then 1.15 square, then 1.15 cube. And D4 onwards I don't have to calculate. You see, D4 they said after 3 years it is going to be 70. So terminal value we know it is 70. Apply discounting factor. They have given 0.8696, 0.7561, 0.6575, and terminal all value also will have 0.6575. Then we do present value, that is 1.15 into 0.8696, X will come like this, second, third, fourth number, and this total should be equal to 52.03. Then you solve for X. That's what it comes to 2 rupees easy 5 marks question. But anyway, but in examination mindset, you may not have thought about it, but if you're conceptually clear, this should not be a difficult problem to solve. Okay, then value of rights. Okay, this is one more area again, small area, but somehow people miss out. Let's read. Pragya Limited has issued 75,000 shares of 10 each. The current market price per share is 24. Company has planned to make a right issue of one share at a price of 16 for every 4 share held. You're required to calculate the theoretical post right price per share, calculate the value of right alone, show the effect of right issue on wealth of shareholder who has 1000 shares, assuming he sells entire rights, and show the effect if the same shareholder does not take any action and ignore the issue. Theoretical post rights. It is again in AS20 and all you would have calculated, very similar process. What is the ratio? We'll just do it based on ratio also. 1 share for every 4 shares held. And what is the market price per share? Before issue it is 24. So if I say if you have 4 shares, I'll do 24 into 4. Existing 4 shares you have, and you will get 1 share. 1 share is worth 16 rupees. If you have 4 share having 24 rupees each, you get 1 share at 16 rupees, and therefore total divided by 4 plus 1. So what is the average will be? 96 plus 16 divided by 5. I think you get 22.4. So basically, if value per share, that is market price after the issue of rights, from 24 it will fall down to 22.4. So what is the value of the rights? 24 rupees before issue of rights, 22.4 after issue of rights. So the difference, how much you get? 1.6, right? 1.6. Yeah, 1.6. 1.6 is for 1 share, but how many shares you are having? I mean, ratio wise, if you compare, it is for every 4 shares. So 1.6 multiplied by 4, you get 6.4. Or what they have done, X right price 22.4, the right share is 16, so difference is 6.4. So you can say value of rights is, you can say like before minus after. Before was 24, after price, X right price 22.4. So 1.6 is value of right multiplied by the ratio. So 1.6 into 4, you will get 6.4. Okay, then they're asking us to show the effect. Show the effect if the shareholder who has 1000 shares. 1000 share means what would be your value now? 1000 shares before issue of rights. What would be each share is worth? 1000 into 24, which is 24,000 rupees before the issue of right. Now what will be the after issue of right? 1000 shares will be worth only 22.4 rupees. Each share will be worth only 22.4. So value will be 22,400 rupees. But he will receive the money also by selling the shares. What is the value per share he gets? We calculated also 1.6 per share. And he has how many shares? 1000 shares. So 1000 into 1.6, 1600. So his value of investment is 22,400. He received cash of 1600. As a result, his value will be 24,000, remaining same. It should remain same. That is the purpose of which giving him the right and purpose of which he can sell it to others. Show the effect if the same holders does not take any action. Does not take any action means this 1600 he has given up. So he is now suffering a loss of 1600. That's what they are showing it here, 1600 loss. So any doubts still here? Should we finish off at a stretch, because we have two problems in valuation and about three problems in mergers, which would take around 40 minutes, I think. So do you want to finish it off, or do you want to take a break and come back and start fresh? We can continue. Okay, then we'll finish it off then. Let's do the next one. Question number 5. Following information are available in respect of XYZ Limited, which is expected to grow at higher rate for 4 years, after which growth rate will stabilize. The multi-period dividend discount model should be applied here also. Base year information means year 0, revenue, EBIT, capital expenditure, depreciation. Information for high growth and stable growth. High growth means the first 4 years, stable growth means after that. Growth in revenue, EBIT, growth in capex, depreciation, risk-free rate, equity beta, market risk premium, pre-tax cost of debt, debt-equity ratio. For all time, working capital is 25% of revenue and corporate tax rate is 30%. So what format we are going to follow here? We'll start with like year 1, year 2, year 3, year 4. This is called the high growth period. And from year 5 onwards, and this year 5 onwards cash flow, what you calculate, all these things I'm going to do present value. Years 5, 4, 6, 7 what I've taken. Year 1 I'll bring it to today value, year 2 I'll bring it to today value, year 3 I'll bring it to today value, year 4 I'll bring it to today value. But year 5, 6, 7 I will not bring it to today value directly. First thing what I do, from all these years I'll bring it to year 4 end. Year 5 1 year back, from year 6, year 7, year 8. So I'll calculate this as terminal value at the end of year 4, and then again I'll bring it to present value. This is called as the value of firm. Just like multi-period dividend discount model. There we use dividend, here I'm going to make use of cash flows, free cash flows. But one interesting point here is we are having different risk-free rate, different equity beta, different market risk premium, different pre-tax cost of debt, different debt-equity ratio. Means to calculate this terminal value, you should use different cost of capital, and from this to bring it to present value, that is year 1, year 2, year 3, year 4, and this terminal value, you are going to use different WSCC. And for that, first step should be to calculate WSCC. That's what I've done here. Check out using the CAPM model. Risk-free rates, risk-free rate they are given 9%. RM minus RF, they have given directly risk premium. RM minus RF they are not given separately, so that is 5% multiplied by beta, which is 1. So 9 plus 1 into 0.05, you get 14% or 0.14 in the stable growth period. Similarly, in the first growth, 10% risk-free rate. RM minus RF is given as 6% into beta is 1.15, and that's how you get cost of equity. Cost of debt, they have given pre-tax cost of debt as 13%. Post-tax means you multiplied by 1 minus tax rate, so 13% into tax rates is 30%. So 13 into 1 minus 0.3, 12.86 into 1 minus 0.3. So this will give you cost of equity, cost of debt, cost of equity, cost of debt under two phases. This I am going to convert this into WACC, weighted average cost of capital, by multiplying by their respective weights. And how do you calculate the weights of debt and equity? They said ratio 1:1, so 1 by 2, 1 by 2, 0.5 each, 2:3, 2 by 3, 2 by 5, and 3 by 5. So you get 0.5 multiplied by the weights, and here it is 2 by 5, so 0.4, 3 by 5, 0.6 multiplied by the respective cost. So 13% is applicable for year 1, year 2, year 3, year 4, and 12% is applicable for year 5 onwards. And this year 5 again brought in today value, and for that also I am going to make use of 13%. So only for calculating terminal value, this stable growth phrase discounting rate is utilized. Okay, so this is regarding the discounting rate calculation. Then as far as FCFF is concerned, free cash flow to firm, let me show the calculation. We'll start with revenue, then subtract all the operating expenses, you get EBIT, Then after tax, you can subtract tax, add depreciation, minus capital expenditure, means all your fixed assets purchases. Then working capital increase is subtracted. So profit after tax, add depreciation, minus capex, minus working capital decrease. The resultant is FCFF, free cash flow to firm. Let's see what are those numbers calculated. Let's check it out for one column at least. 2000 is the base revenue. They said growth is 20%. So 2000 into 20% or 1.2, you get 2400. Again multiplied by 1.2, again multiplied by 1.2, again multiplied by 1.2. For first 4 years, the growth rate is 20%. Year 5 onwards, the growth rate they stabilize at 10%. So here last year I'll multiply it by 1.1. Coming to EBIT, you can do EBIT or you can do PAT also. EBIT they said 300 crores. This also will increase by same percentage. So 300 into 1.2, then multiplied by again 1.2, again multiplied by 1.2, again multiplied by 1.2, again multiplied by then last year 1.1. Profit after tax, this you simply multiply before tax into after tax, you multiply it by 1 minus tax rate 30%, so you can directly multiply it by 0.7. Depreciation, what they have told regarding depreciation, depreciation is 200 crores. Depreciation is also growth in capital expenditure and depreciation, so depreciation also growing by 20%. Base is 200, so 200 increase it by 20%, 1.2, increase it by 20%, 1.2, increase it by 20%, 1.2, increase by 20%, 1.2. But last year, see, capital expenditure is offset by depreciation. So basically they will be plus and minus equal. They will set off each other. And that's why the last two you can see it is 0 each. They set off each other. Well, capital expenditure also same growth, they say 20%. Capital expenditure base year is 280. So what you are going to do, 280 increase by 1.2, increase by 1.2, increase by 1.2, increase by 1.2, and net amount last year will be 0 because they will set off each other. Then working capital, they said it will be 25% of revenue, and therefore revenue we just estimated here, see 2400, 25% of that. 2880, 25% of that. 3456, 25% of that. 25% of that. 25% of that. This is the working capital. But what we require is increase in working capital. So 400 becoming 600. 100 is increase in working capital. 600 becoming 720. So 120 increase. 720 become 864, 144, and so on. So then cash flow you calculate FCFF, free cash flow, profit after tax plus depreciation minus capex less increase in working capital, that is free cash flow to firm. And last year you please observe, once you calculate free cash flow to firm, don't stop at that point. You apply cash flow of year 5 divided by K minus G, and for which K use this the stable growth period of 12%. This is what I'm going to use it here, that 12% number. This amount I get is terminal value, and this is which year cash flow I'm using. This is 5th year cash flow, and therefore terminal value will be 4th year, 1 year less. So cash flow by K minus G. Then you multiply by discounting factor year 1, year 2, year 3, year 4, and year 4. The last two cash flows will converge because they're happening at same point in time. Multiply, add all of them, you get value of firm. And if you know the debt amount, you subtract debt, that is value of equity, if you have to calculate using that. So any doubts in the value of firm and value of equity calculation? Okay. Last problem, where we have something called as EVA, economic value added. Economic value added is what is the difference between what you expect and what you get. So EVA is calculated by what you get is NOPAT, net operating profit after tax, which is profit after tax plus interest into 1 minus t, or EBIT into 1 minus t, that is all same, minus expected cost. Expected cost means capital employed multiplied by WACC. So capital employed is the amount invested in the business. WACC means the expectation from that employment. So this is your expected cost, capital employed into WACC, expected cost. No PAT, net operating profit is the actual profit. Actual profit minus expected profit, that is economic value added. In a way, if I compare with this portfolio management chapter, this is like alpha generated. So if you remember Jensen's alpha, it is over and above the expected rate of return as given by CAPM return. CAPM return tells you what is supposed to be the return considering its risk. But if you are expecting above that, that means the stock is likely to give you alpha. And in terms of company, you are supposed to generate capital employed into WACC. But if your operating profit is more than that, you are exceeding the expectations. Okay, let's do a problem based on that. The following information is given for 3 companies that are identical except for their capital structure, total invested capital, debt assets ratio, shares outstanding, pre-tax cost of debt, cost of equity, net operating income, net income. Tax rate is uniform 35%. Compute the weighted average cost of capital for each company. Compute the economic value added based on EVA. Which company would be considered as best? If industry P ratio is 11, estimate the price for each share of the company. Also give your observation on using the P ratio to estimate the price for shares of all companies. Calculate the estimated market capitalization for each of the companies. Fine. Weighted average cost. First of all, I need to know cost of equity. Yeah, cost of equity they only have given, but we need cost of debt. What they have given is pre-tax cost of debt. We are going to do multiplied by 1 minus t. 16% multiplied by 1 minus 0.35. This will give me cost of equity, cost of debt. Once I know the cost of equity, cost of debt, I can multiply it by the weights. Debt by asset ratio means the weight of debt is 0.8 and the weight of equity is 0.2. So you can see pre-tax cost of debt into post-tax, 16 into 1 minus 0.35, that is 16 into 0.65, you get 10.4, like that 8.45, like that's 9.75. Cost of equity they only have given WACC 10.4 multiplied by debt by asset ratio. Cost of equity 26 multiplied by, if debt ratio is 0.8, equity ratio will be 1 minus of that. So like that for one company, second company, third company, you get WACC. Then EVA is calculated by, they have given what? EBIT. So let's calculate for one of them, others will follow the same process. EVA. No PAT means EBIT into 1 minus T minus capital employed into WACC. EBIT is for this company 26,600 into 1 minus T, 1 minus 0.35 minus capital employed, that is invested capital 1 lakh. WACC for the first company we calculate as 13.52%. I think the 30,520. Just calculate 26,600 into 0.65 minus 13,520. 3770. Yes, they have done in full table calculation, but that's what it actually means. It is EBIT into 1 minus T is no PAT minus capital employed into WCC, and that is what is EVA. So compute EVA for each company that we have done based on EVA, which would be the best. So which is the best, highest? First company only. And why first company is best? Because EVA higher represents they are exceeding the expectations. When you're exceeding the expectations, that means company is making good progress. So based on EVA, orange would be the recommended company. If industry P ratio is 11x, means 11 times, estimate the price share for each company. So using P ratio means I need to multiply it by EPS. For EPS, they have given net income, or we have EBIT. From EBIT, you subtract interest. How do you subtract interest? We have invested capital 1 lakh. Then debt assets ratio 0.8. So can I say debt will be 80,000? Multiplying by debt ratio, and rate of interest is 16%. Pre-tax cost, pre-tax of debt means it is interest. So 80,000 into 16%, you get interest. So from EBIT, I subtract interest, I get earnings before tax. Then the tax rate is given, so we get profit after tax. Number of shares do we have? Yeah, shares outstanding. We have profit after tax divided by number of shares. You get EPS. EPS multiplied by 11, P ratio, and that's how you get the market price estimated. Alternative answer, because you see you can use the net income also directly. You get same answer only, but anyway, net income directly they're given in the problem. So directly divide by number of shares, you get the market price per share. Last part of the question, you have to estimate the market capitalization. What is that market capitalization? We already got the market price per share. You simply multiply it by number of shares. Or what you can do, we know the net income, profit after tax. This you can directly multiply it by P ratio. That also will give you the market cap. One question they are asking, theory. What is your opinion on applying same P ratio for the company? It would not be appropriate, because you know the risk level of each company would be different. The debt is different, EVA is different, their capital structure is different, and therefore applying same P ratio for all the companies without considering the risk element may not be appropriate. That's what they have given in the form of this sentence. So you have to adjust for risk factor. Okay, so here we come to the last chapter, which is mergers. So that's how any class would end, I think, mergers, because mergers M stands for marriage. So once marriage happens, all the other chapters are closed. So what kind of questions you can expect from merger is one mainly based on P ratio, and then we have the bank merger, and then we have some problem of, we call it as like minimum ratio, maximum exchange ratio, things like that. Basic formula of swap ratio is, okay, when we do the problem we'll understand. The formula is target company by acquiring company, maybe EPS based, maybe market price based. I'll say, remember, like a TA kind of thing, numerator T, denominator A, target by acquirer. But if the ratio is unfavorable, meaning especially in case of bank merger, we will have NPA. In that case, the formula will be reverse, because lower the NPA, the better it is. Therefore, the formula will be inverse. All the inverse ratio, this formula will be opposite. Let's understand with the help of problem. So come to the question number 1. C Limited and P Limited, both companies operating in the same industry, decided to merge and form a new company, S Limited. Relevant information is given. Annual earnings, number of shares, P ratio. The merger will be affected by means of stock swap, 3 shares for 1 share. After merger, due to synergy benefits, annual earnings are expected to be 8% higher than sum of the two companies individually. Further, it is expected that P ratio shall be average of P ratio of two companies before the merger. Evaluate the extent to which P Limited shareholder will be benefited per share from the proposed merger. Okay, so usually we write in our regular format. Let me write in that format. So C Limited, P Limited. We have profit after tax, and I'll write one more also. This is like C and P are like acquirer targets, and one we are going to write it as merged entity. Profit after tax 10,000, 5,800. Number of shares 4,000, 1,000. P ratio. Okay, when I know PAT and number of shares, I can calculate EPS. 10,000 by 4,000, 2.5. 5,800 by 1,000, I think 5.8. P ratio 8 and 10. So I can calculate market price per share because I know P ratio and my EPS. So 2.5 into 8, 80,000. Nothing but PAT into, sorry, this 2.5 into 8. How much you get? 20,000. So 20, sorry, 20. And 5.8 into 10 means 58. You can compute market value as well. You can multiply by number of shares. So 10,000 into 8 means I think it is 80,000, and 5,000 into 10 means 58,000. Regular calculation we do with this whether required or not in the mergers. Okay, then merged entity, what and all taking place? It is, you are going to get 8% higher than this. So 10,000 plus 5,800, increase it by 8%. So I can multiply it by 1.08. See how much it comes to? 17,064. Then what about swap ratio? The swap ratio is 3 shares of C Limited for 1 share of P Limited. So how much you are going to issue then? 3,000. 3 shares for 1 shares. So you will issue 3,000. So 4,000 plus 3,000, the merged entity, it will become 7,000. So we can calculate EPS then. 17,064 divided by 7,000. 2.44. Okay, 2.44. P ratio, they said it is going to be average. So 10 plus 8 divided by 2, this will be 9. So I know the EPS, I know the market price, so I can multiply 9 into 2.44. How much you get? 9 into 2.44? 21.96. Market value, how do I calculate market value? One is 21.96 into 7,000, or I can also do 17,064 into 9, net profit into P ratio. Both should be same approximately. Check it out. See, is it approximately 15,000 something? No, 1 lakh 53 576. If I do this one, 1764 into 9, That is more closer actually, because the 2.44 would be rounded off for that reason. Anyway, it does not matter. So now you can see that 80,058, 1,53,000. So we are going to understand how this is being given or how it is being used as a beneficial thing. You can do it in two ways. I'll show you both the ways. Now 1,53,576. This is belonging to two kinds of shareholders. Both the shareholders are in the merged entity now. So what is C shareholders and how much belongs to P shareholder? C shareholder is having how many shares? They are having 4,000 shares. So out of 7,000, so the ratio I can say 4 by 7. And P shareholder is 3,000, so I can say it is 3 by 7. So 4 by 7 into 1,53,576. 87,756. $65,818. So that is the number you're getting. Minus the existing. This is the value in the new company. This is after merger, you can say. What was before merger? 80,000. So you can see 7758 is the benefit for or impact of merger for C shareholders. For P shareholder, it will be minus 58,000. They have not asked, but if you write 7,818, that's a benefit for target company shareholder. You can also do it in one more way. You can also do it on per share basis. I'll show you that as well. You see, for acquirer shareholder, what is the market price per share after merger? It is 21.96, and before merger it is 20. So 1.96 per share I can say. And how many shares they have, C company before merger? 4,000. So multiply approximately, see if you get 77, some 60 maybe. 7740. 7840, is it? Okay. So much difference, huh? Like rounding off only, but anyway, 7840. You can similarly do for other also, but when you do for target company, you have to be extra careful. I cannot take 21.96 minus 58, because this 21.96 is the share of merged entity, and for that, if you want to compare it with the pre-merger, then you should apply the swap ratio, then it is comparable. That 60 something you get minus 58, some benefit you get. So only thing, when you're applying the target company analysis, please multiply it by the swap ratio to make it comparable before merger. And we will apply this concept in the next problem. You will understand even more better. Let us take up the next problem. ABC Limited is intending to acquire XYZ Limited by way of merger. Following information is available. ABC Limited, XYZ Limited, total earnings, number of shares, P ratio. Determine the maximum exchange ratio acceptable to the shareholders of ABC if P ratio of the combined firm is expected to be 8. Determine the minimum exchange ratio acceptable for shareholders of XYZ if the P ratio is combined firm is 10. Make calculation in lakhs in multiple and combine compute ratio up to 4 decimal points. Okay. First of all, you have acquirer and there is targets. So acquirer is going to give purchase consideration to target. That's what is the exchange ratio we are talking about. So if you think from acquirer, you ask him, what is the minimum you want to pay? He will always tell 0. Acquirer, we want free of cost. He will always tell 0. You ask targets, what is the maximum you want? I want infinity. There is no limit. So these two questions will not be asked in the exam. It is always what is the maximum that acquirer would be ready to pay and what is the minimum that target would be expecting it. Okay. So they'll always ask from the acquirer point of view. You can see ABC Limited, the acquirer, they'll only ask you maximum. Minimum it will be 0. So they cannot ask you that. Then how do we calculate this number is very simple. What we just discussed, from the acquirer company point of view, his benefit or his value after merger, I will say market price per share after merger. For the acquirer shareholder, market price per share after merger should be equal to market price per share before merger. Why is it equal? Because this is the tolerance level. This is like a indifference point. If market price falls below this, then he will not even talk about this. Or if I am calculating the benefit, like in the previous problem, the difference between these two I am going to calculate as gain or loss. And here I want to make the difference as 0. Up to what level I am ready to issue exchange ratio such a way that I am not expecting any benefits. Or in other words, these two are equal. And market price before merger we know already in the problem. Oh, okay, we have to calculate. Let's do one thing. Have regular formats. ABC, XYZ, what and all they have given. Earnings, profit after tax, 1200, 400. Divide by number of shares. 400, 200. So we can calculate EPS. So 1200 by 400 means 3. 400 by 200 means 2. Yes. P ratio, they have given as 8 and 7. So when the P ratio is given, we can calculate market price per share. 3 into 8 is 24. 2 into 7 is 14. We can calculate market cap. Market cap PAT multiplied by P is easier. Or number of shares into market price per share. 1200 into 8, 9600. And 400 into 7, 2800. Now, when you think from ABC Limited point of view, acquirer shareholder, he want to make sure his market price of 24 is protected under any circumstance. That is MPS before merger, which is 24. You want to make sure that it is same thing even after merger. MPS after merger. Before merger is 24. After merger, how do you calculate? That will be calculated by EPS after merger multiplied by P ratio after mergers. That is a basic formula. EPS into P ratio is after merger. How do you calculate EPS? Earnings of the merged entity. So I'll write like this: profit of the merged entity. Means it might be some synergy also might come in some problem, divided by number of shares in the merged entity. And how do you calculate number of shares in the merged entity? Whatever the acquirer company number of shares plus the shares issued, and shares issued will be whatever the target company number of shares multiplied by swap ratio. This is going to give you EPS, then you multiply it by P ratio of the merged entity. If I am doing the same formula for target company, one extra thing I should do. For the entire thing, I'll multiply it by swap ratio. Because for the target company shareholder, direct comparison not possible. I have to make it comparable, means I need to apply swap ratio for target company shareholder, which we'll do as well for this problem. So what is a merged entity? This is 1200 plus 400. I'll say 1600. Acquirer number of share is 400. How many shares are to be issued? I don't know. Let's say I'll take it as X. I know I can multiply it by target, but I'll just simply take it as X equals 24. Multiplied by P ratio. What is the P ratio of the merged entity should be? They want the combined form to be 8. So cross multiply. So X I'm taking it as number of shares to be issued. So 24 into 400, 9600 plus 24 into X, 24X, 1600 into 4, is it 14,400? No, 12,800. 12,800. Okay. So 12,800 minus 9,600 divided by 24. 133. Is the calculation correct? Okay, 133.33. This is the number of shares to be issued. And how many shares they have? 200. So 133.33 divided by 200, some 0.666 I think, or 0.67. That would be the maximum exchange ratio. Yeah, 0.666 I think. And it does not matter. That's what Institute also have done, but they did something circus, so I did not use that. Anyway, we could understand, but slightly confusing for you to apply these things, may not be convenient. So what we are going to do for acquirer shareholder, exact same thing we do, but we simply multiply it by the swap ratio. And what is swap ratio? We don't know. We have to calculate it. No, this is for first part of the question. Second part of the question, from his point of view, you have to calculate. Determine the minimum exchange ratio, assuming P ratio to be 10. Okay, I will calculate that. I hope this is done. So I'll calculate from target company shareholder point of view. MPS before merger should be equal to MPS after merger. And one more thing I do is this, I'll multiply it by swap ratio, which we are yet to going to calculate. Mind that we don't know that. MPS before merger is 14. After merger, don't take anything. We need to calculate. That will be done by EPS into P ratio. EPS is 1600 divided by 400 plus number of shares to be issued. So what I do, I'll take excess swap ratio. So I'll get the answer directly. Or should I take number of shares to be issued as X? Both ways you take it. Let's say number of shares to be issued as X, just like this we have take, multiplied by P ratio. P ratio is, they want to be 10 multiplied by swap ratio. How do you calculate the swap ratio? The number of shares to be issued divided by existing number of shares. Number of shares to be issued I have taken as X. Divided by existing number of shares, 200. So 200 I'll cross multiply, 200 into 14, 2800. Then X I'll take it inside, that is 1600 into 10, 16,000 X divided by 400 plus X. So cross multiply 2800 into 400, 11,20,000. So much big number. Okay, what is this? Eleven lakh 20,000 plus 2,800x equals 16,000x. So 16,000 minus 2,800, 13,200x, and this is 11,20,000. So x equals 13,200 by 11,20,000. 0.01. Something wrong. What is? It's just the calculation. MPS after merger. Profit is 1,600 by 400 plus X. It's too small number. Into P ratio. 84 you're getting. What is mistake I have done? It's correct only, is it? Okay, 11,20 by 2200. Okay, so 84.88. This is the number of shares to be issued. So swap ratio will be 84.85 divided by 200. 0.4. Okay, so 0.4. So you see what is the minimum these people are expecting is 0.42 and maximum they are ready is 0.66. So usually in between these two negotiation will take place. If it is outside these two limits, then merger will not take place. Anyway, this is the minimum ratio, maximum ratio, simple logic, just the simplification you have to apply. Sometimes in the problem, you know what they might tell? They will tell you the earnings should be maintained. Here what we have calculated such a way that market price is maintained. If earning is maintained means then I'll do EPS before merger is equal to EPS after merger. So I don't have to multiply it by this P ratio. That is again similar process is going to be applied. Okay, let's go further. Just two more problems. With that we can conclude. XML Bank was established in 2001, was doing banking business in India. The bank is facing very critical situation, the problem of gross NPA at 40%, CAR, that is the capital adequacy ratio, at 2%. Net worth of the bank is not good, shares are not traded regularly. Last week it was traded at 4 per share. RBI audit suggested that the bank has either to liquidate or to merge with the other bank. A typical Indian solution. If you have a problem in life, either get married or you have a go and die. I mean, both are same ultimately. So either liquidate or merge. ZML Bank is professionally managed with low gross NPA of 5%. It has net NPA 0% and CAR at 16. Its share is 64. The board of directors of ZML has submitted a proposal to RBI to take over of XML on the basis of exchange ratio. What exchange ratio? Okay, maybe we have to calculate. The balance sheet are given. It was decided to issue the shares at book value to the shareholders of XML. All the assets and liabilities are to be taken at book value. For the swap ratio, weights are given: gross NPA, CAR, market price, book value. You're required to calculate swap ratio on the above rates, calculate number of shares to be issued, prepare balance sheet after merger, compute CAR, gross NPA after merger. So the swap ratio now is to be calculated based on weighted average. So we have to calculate 4 things: gross NPA based, CAR based, market price based, book value based. Now these 3 are not a problem. Higher the ratio, the better it is. But the gross NPA alone, the formula will be reversed, because NPA, if it is higher, you can't give them more number of shares. You have to penalize them. And therefore, first you calculate the book value. Book value, they have done asset minus liability. You can do straightforward share capital plus reserves and surplus, because no adjustments are there. Share capital 70, reserves 35, 105 divided by 7, that is number of shares. 250 plus 2750 divided by 25, that is the book value per share. You get 15 and 120. Gross NPA, this alone will be reverse. That is, normally what we take is TAR, that is target by acquirer. You can see 2 by 16 CAR, target company CR. At the beginning they said 2, acquirer company CR 16, so 2 by 16. Then we have market price also target by acquirer. Target is 4 per share, acquirer is 64 per share, so we are going to do 4 by 64. But NPA is 40 here, and NPA is 16. What is it, NPA here? 5% gross NPA. So I don't do 40 by 5. Imagine if you do, what will happen? You give them 8 shares because they have more NPA. That is not right. So it's going to be 5 by 40. Book value, as we computed here, it will be 15 by 120, target by acquirer. Then multiplied by the weights they have given, multiply just like the probability we used to do. Weighted average 0.1. So swap ratio is 0.1. So 7 crores into 0.1, you are going to issue 0.7 crores or 70 lakhs shares. Then there is one small thing which I don't agree. I'll tell you later. They said the number of shares to be issued at book value. Therefore, how many shares are issued? 70 lakhs shares, face value 10 rupee each, that is 7 crores. And what is the book value taken over? Here also you can see the taken over value is 105. So 105 is the net book value taken over, but the share capital issued is 7 crores. So balance 98, they called it as capital reserve. I have a difference of opinion. When they tell book value, it should be issued at 120 per share, because book value according to me is book value per share. So if you issue 120 multiplied by 0.7, this would have become 84. But asset taken over is 105. Therefore, we will get the capital reserve as 21. But does not matter. This 10 rupees extra, I mean 110 rupee extra, 110 into 0.7, you get I think 77 something. I will show it as security premium. Shares issued above face value. 77 plus 21, that means again it comes to 98. So ultimately what you show in balance sheet does not matter. So ultimately it is net worth taken over 105, share capital issued 7, difference capital reserve. Share capital 250 existing, plus 7 crores issued, and reserve surplus 2750 existing plus 98. So that's how you got they are shown separately, 2750, 98 separately. All other things are line by line items, that is deposits of 2000 plus 20,000 for 22,000, cash in hand 200 plus 1250, everything else is line by line item. In fact, even reserves also will be line by line only indirectly. So all other items are added one by one, and that's how they got the balance sheet. Oh, next part of it is not printed. Fine. Compute CAR and gross NPA after merger. I think maybe some other question it was asked. I've added here. Does not matter. How do you calculate this CAR, capital adequacy ratio, after mergers? First of all, do you even remember something called as capital adequacy ratio, where you have to calculate Tier 1 capital funds, Tier 2 capital funds, Tier 3 capital funds, and Allah was not there. There was only Tier 1 capital funds and Tier 2 capital funds. Then we computed risk-weighted assets, like if it is cash balance with RBI 0%, balance with other banks 20%, then balance, I mean, loan guaranteed by government of India will be 0%, we take a weighted average. Like this we can't apply, that would not be appropriate. So what we do is we look at the situation before merger. So what was there in XML Bank and ZML Bank, what was the ratio we had? The CAR ratio was 2% and 16%. XML was 16%. No, XML was 2%. Yeah, XML 2%. ZML 16%. This is the existing number. We don't know the assets side, but definitely we know the liability side. It means capital funds. You can look at the balance sheet. What is the capital funds? These people will have 70 plus 35, which is 105. And here capital funds 250 plus 2750, 3000. CAR means numerator is capital, denominator is assets. CAR formula is this: capital divided by the asset, risk weighted assets. Now here capital we know 2%, which represents 105. So how much for 100? This capital represents 2%. How much for 100 means you will divide. So risk weighted assets, not just assets, risk weighted assets, 105 by 2%. 525. 5250. Okay. So 3000 by 16%. 18,750. So this is before merger. So merged entity, you add 5250 and 18250, 18750. Yeah? So this is 24,000. Capital, we have prepared the balance sheet only. 257 plus 2750 plus 98. Sum of all those things. It happened to be same, but not necessarily, because ultimately it became capital reserve. Everything is taken out book value. Practically may not be taken out book value. But anyway, so you add 3000 plus, 105 plus 3000, 3105. That's what number you got, right? 3105. Okay. Then what is the ratio? In the sense, 3105 divided by 24,000 into 100. 12.94%. So this is the CAR after merger. Similarly, gross NPA also will calculate. You can do it later. How are we going to do? I'll just tell you the process. When we say assets, that is, we mainly talk about the advances. That is the loan. And what are the NPA percentage? 40% is NPA. So 1740 into 40%. This represents the NPA of XML Bank. And ZML Bank has NPA of 5%. So 13.5 into 5%. This is the NPA of ZML Bank. So once we get this number, you can sum it up. You get the total NPA of the merged entity divided by total advance, which is nothing but sum of these two numbers. You'll arrive at the merged entities NPA. Whatever you calculate. Hope you got the process. CAR was more critical, which we calculated. Okay, so last problem, levered buyouts. Interesting one. Let us read. CEO of the company thinks that shareholders always look for EPS. Therefore, he considers maximization of EPS as company's objective. His company's net profits are 80 and P multiple of 10.5. So quickly we'll do one thing. Let me write what they have given. So they have not given company name, acquirer, target. Net profit of the company 80 lakhs. So profit after tax 80 lakhs. P ratio 10.5. He wants to buy another firm which has current income of 15.75, 15 lakh 75,000, and P ratio, P multiple of 10. What is the maximum exchange ratio CEO should offer so that he could keep with the EPS at current level? Do you remember previously we discussed the MPS will be same before after, your EPS should be same given the market price of acquire and target is 42 and 105. So market price per share 42 and 105. So when I know the P ratio and MPS, what we can calculate is EPS. MPS by P ratio. So 42 by 10.4, I think 4, and 105 by 10, 10.5. And once I know the EPS and the PAT, so we can calculate the number of shares. 80 lakh divided by 4, number of shares 20 lakhs, and here number of shares 15 lakh 75,000 divided by 10, divided by 10.5. How many shares? 1 lakh 50,000. Okay. We can also calculate market cap because we know the PAT 80 lakh, P ratio 10.5, so 80 into 10.5, 840 lakhs. Okay, actually we don't require market cap now because this problem is about earnings. Let's not worry about the market cap there. Let's just focus on this. So they want to maintain the P ratio, EPS should be remaining same. So what would be that? EPS before merger should be equal to EPS after merger. EPS before merger for acquirer is 4 rupees, and he wants to maintain the same 4 rupees after merger. For that, what we are going to do? Profit of the merged entity, which is 80 lakhs plus 15 lakh 75,000 plus 0, because if there is any swap and any synergy benefits, divide by number of shares. Existing shares are 20 lakh plus X, some number of shares to be issued. Simplify and see how much you get. How many shares? Is it 1,50,000 only? Three lakh 93,750. 3,93,750. So this is the number of shares to be issued. So what is the ratio going to be? 3,93,750 for existing number of shares, which is 1,50,000. Number of shares issued for existing 1,50,000. So ratio is 2.625. One small point. What is the swap ratio based on EPS? In this problem, if you calculate based on EPS, that will be EPS of the target by acquirer. Target EPS is 10.5. By acquirer EPS is 4. It is same. So when they tell you they want to maintain EPS, you can simply go for swap ratio based on EPS, but subject to one condition, there should not be any synergy benefits. If no synergy benefit, this shortcut works. If you have synergy benefits, then you have to follow the same process. So this shortcut works only if no synergy. Only if no synergy, this shortcut works. Okay, so last part of the question. If the CEO borrow funds at 15% and buys out the target company by paying cash, that's what I mean by levered buyout. You borrow and you acquire. How much should he offer to maintain his EPS? Assume tax rate of 30%. Same thing, what he's going to do is, he is going to borrow money. So when he borrow money, what he has to pay is interest. So his interest will be subtracted minus interest. How much interest is going to pay? At the rate of 15%, but on what amount? On whatever amount he is going to borrow. That is, I don't know the amount he is going to borrow, I'll take it as X. On that you are going to pay 15%. And this is profit after tax. So this also should be after tax. So 1 minus tax rate of 0.3. And one more important point is, I will not issue any shares. So denominator will be just 20 lakhs. Now you solve for X, that is representing the maximum, not exchange ratio, the maximum amount of loan that you can take, so that you maintain the same EPS. By taking loan, you pay interest, and when you pay interest, you have to make sure that your earnings EPS is not affected. So you just simplify it. That is 20 lakh into 4 means 80 lakhs. 80 lakhs plus 15 is the 95 lakh 75,000 minus this is what, 0.105x. Simplify for x. So 15 lakh 75,000 divided by 0.105. Is it 15 lakh? 150 lakhs. Okay. So this is the maximum loan he can borrow on which your EPS will remain same. If you pay more than this, EPS starts reducing. If you pay less than this, his EPS will be more than the current one. His cutoff point, indifference point is 15 lakh. Actually, you can also calculate like this. By acquiring company, what is the benefit you're receiving is 15 lakh 75,000, for which you have to pay interest at 15%. So capitalize this number, 15 lakh 75,000 divided by, don't divide by 15%, divide by 10.5%, applying this tax rate. 15 lakh 75,000 divided by 15% into 1 minus 0.3. So divide by 10.5%, you will get same answer. Anyway, but I recommend you follow this approach, more logical, more clear, even in presentation in exams. So this is with respect to mergers. So bank merger problem, levered buyout, minimum maximum exchange ratio, and regular P ratio that we have covered. So from all the chapters, whichever I thought which is most repetitive problems and most important from this exam point of view, I tried to cover it. Theory part, as I told you, is not covered. That is a separate marathon session is there. So anyway, tomorrow you have time, so please watch that 1 day 7 hours purely on theory. I've covered from the beginning, like what is value at risk, debt securitization process, every chapter theory asked in the previous exam question, I have discussed it. So please watch the theory marathon. Quite a few people have messaged me after the exam that the theory question they could achieve confidently after watching that video. I hope it will be useful for you also. So that is on dot 5 o'clock and we have completed it. So long sessions, I hope that you made your time somewhat to an extent useful, because even though these are free sessions, your time is invaluable. That is difficult to convert it to numbers. Anyway, it will be available in the YouTube also, so anytime later you want to watch it again, you want to take the form problems, you can please watch it and write it down. Any doubts you have, you can follow it. Any doubts you have later also, you can still message me. My mobile number is there, my email id is there, telegram channel also you can contact. So that's it from my side. I hope you found it useful. As usual, I'll end with my favorite closure sentence. Most people live as if they don't die, and most people die as if they've not lived. Only few people will be alive even after their death, because of the work when they do when they were alive, and they made the difference to others' life. I wish you to be one of them. All the best for your examinations, and thank you for your patience. So take care. See you. Bye bye.